Welcome to Intuit's Bookkeeping Certification Program. This program is made up of 4 courses: Bookkeeping Basics, Accounting for Assets, Liabilities and Equity in Accounting, and Financial Statement Analysis. Each course has similar activity types. These include videos, discussion prompts, and practice. In the videos, you'll meet your bookkeeping coach, Bianca. Bianca and her Bookkeeping Rescue Show will make an appearance throughout each course. You'll go through bookkeeping topics and situations with Bianca as a guide. The discussion prompts are your opportunity to think about what you've learned and consider what it means for you. Lastly, practice will consist of quizzes and interactive activities where you can self-check what you've learned. Now that you know what's waiting, you're ready to start. Welcome back to Intuit's Bookkeeping Certification Program. If you're watching this, then you're gearing up to start working through the last course of this certification. You've come a long way on your bookkeeping journey. Give yourself a pat on the back. Now, I know you're a pro at this already, but just as a reminder, this course is broken down into 4 modules, and each module contains 3 to 4 lessons. Like before, in each lesson, you will find a variety of content, including things like advice from experts, demonstrations, hands-on practice activities, readings, knowledge checks, graded quizzes, and peer discussions. In your final course, Financial Statement Analysis, it's time to put your bookkeeping skills into action and learn how to analyze financial statements on a holistic level. Here you'll learn how to reconcile different types of accounts, check for accuracy, and troubleshoot errors. Additionally, you'll practice how to apply different analytical methods to key financial statements and understand how these methods inform a variety of business decisions, all preparing you for a final case study, which will put the skills you've acquired to the test. When you've completed this course, you'll add these final skills to your knowledge bank. Describe and illustrate the use of a bank reconciliation in controlling cash. Outline the purpose of financial statements in relationship to decision-making. Describe basic financial statement analytical methods. Apply quantitative skills to analyze business health. Like before, there are no prerequisites to participating in this course, but the items covered in this course builds on the knowledge and skills from previous content. Because of that, if you haven't already, I recommend that before taking this course, you first complete Bookkeeping Basics, Assets in Accounting, Liabilities and Equity in Accounting. As with all of these courses, you don't have to complete everything in one sitting. By now, you've probably found a method that works for you, but we recommend carving out 4 to 6 hours per week to review and complete the course material. Don't forget to find time to practice your new skills. Good luck and happy bookkeeping.
Welcome to a very special episode of Bookkeeper Rescue. It might be my favorite. Oh, but it's so hard to pick favorites. But if I had to pick... Anyway, this is where we get to go back and visit all of our business owners from the season and find out what they've been up to since we left them to keep up with their books. Hopefully, our business owners are feeling comfortable with the accounting cycle, entering transactions, and tracking assets, liabilities, and equity. But something tells me they'll need our help with some more advanced skills. Before we check back with our first business, I want to make sure you have a general understanding of these advanced bookkeeping skills. First, reconciliation. Have you ever looked at your credit card statement and been surprised by the balance? Did you then go line by line to double-check for errors or suspicious charges? If so, you already have reconciling experience. To me, reconciliation is like good accounting hygiene. Just like you gotta floss those pearly whites regularly, you need to be reconciling regularly for the best results. Truth be told, it's one of the most important services a bookkeeper can provide. I know we've both put a lot of work into helping our business owners accurately record their sales and expenses in order to produce financial statements. And you may be thinking, so what? Well, that's a good question. We put all this effort into producing accurate statements because they help us tell the story of the business and communicate its financial health. Once our business owners know how to interpret the financial statements, they can analyze the information and use it to make important decisions to drive the business forward. Maybe an example would help. Take a listen to one of my colleagues.
It's really important to understand financial statements so that you can interpret them for your clients, mostly because sometimes they have questions and they'll throw you a zinger every once in a while, like, can I afford to buy this new piece of equipment? Or should I get a loan for a new piece of equipment? So your financial statements are really going to help you be able to see if they have the cash on hand, and if not, do they have the debt ratio to assets that will allow a bank or a lending institution to give them a loan for the new equipment. So it's just so important to be able to interpret those. And that's just the balance sheet. Profit and loss is showing how they've been doing during the year, this quarter versus last quarter, this month versus last month. You'll be able to tell trends in how they're doing as far as income and expenses. So you need to be able to have those discussions with the client. And then finally, the statement of cash flows is really important to interpret, because sometimes your client will look at the bottom of a profit and loss and say, oh, I made $100,000 this year. Why isn't there $100,000 in the bank? So the statement of cash flows will actually explain that, yeah, that may have been your net income, but you also used the money in different ways. It could have been you did an owner draw, or maybe you paid off a loan or bought a piece of equipment. So the financial statements are so important to have a basic understanding in. So I encourage you to get to know them. So just some tips for staying within your scope of work. We as bookkeepers shouldn't be really advising on how to plan or make decisions on purchasing a piece of equipment or anything like that. What we need to do is just tell them the facts, what has happened, and this is where you are now. They can take that information to their advisor or their CPA, and from there, the advisory work starts.
Angie has a big interview scheduled first thing tomorrow. Time to get some rest.
So tell me why you're interested in this role with our company. Can you tell me about a time you faced a challenge at work and how you overcame that?
Luckily, it was just a bad dream. But how can Angie make sure this nightmare doesn't become reality? Interview preparation. That's how. Lucky for Angie and you, we have this handy guide, How to Prepare for Job Interviews. Take a look.
Seems like I was just here yesterday, but can you believe it's been months? Hi, Sophia. Good to see ya. Is everything okay?
Oh, Bianca! What a surprise! It's nice to see you, and I'm so glad you're here. Had I known you were coming, I would have made sure Summer stayed, even if I had to lock her in the salt cave.
Yeah. Where is Summer? I didn't see her van out front. Is she teaching a yoga class or something? Diversifying the business a little bit?
Well, not exactly. I mean, yes, business is doing really well, actually. But with tax season coming up and me trying to fix all of this, I'm glad you're here.
Oh, boy. Okay. It sounds like I'm going to need something stronger than my half-calf soy latte here. What's going on?
Well, Summer and I had an argument this morning. I borrowed her van and found all of these receipts stuffed everywhere. Some were supplies purchases, others looked like sales receipts. Some might be personal, but I couldn't tell. They were such a mess. When I asked her what these were doing in the van instead of our files, she told me the chaos of clutter is good for practicing centering oneself. And, well, naturally, you can imagine how upset I was.
Naturally.
So here we are. Business has been growing, and we've been doing good. And yet, she's at it again. When I tried to tell her we have to stay organized, she walked out and then drove off. I thought our books were solid, but now I'm not so sure. I was already nervous about tax season, and this just makes me question everything.
Well, Sophia, I'm sorry you and Summer always seem to find yourselves here. But with reconciliation, these things can't just happen unexpectedly like this.
Bianca, even though she drives me crazy and we get into it sometimes, we always reconcile. But I'm not sure how that will keep it from happening again, though.
Oh, honey, I mean reconcile your books. Reconciliation is a process every business should take to ensure there are no errors or surprises in your accounts, on your books, or in your system. It's a surefire way to summer-proof your business.
Well, it looks like I need a bit more education on how to do this, because I'm not willing to rely on Summer's spirit guides to keep us in check.
Good call. Remember I told you that with family, you've got to do things by the book. You can love them, but you've got to verify your business by more than a feeling. Am I right? That's where reconciliation comes in. Since we didn't cover this in full detail when talking about the accounting cycle, let's dig in and help these sisters out. To understand how to do reconciliation, we've got to start with what it is and the types there are. Just like Summer and Sophia being out of balance and then coming together, reconciliation is bringing internal and external data together, making sure they balance and are correct or on the same page. Get it? Reconciliation is kind of like one big matching game. Like a clean load of socks, there's nothing hard about the process. It's just tedious to match things up, especially if you're a big company with lots of transactions. And inevitably, when there's one sock alone, you know you've got a problem. When it comes to the types of reconciliation out there in the world of bookkeeping, there are as many types as there are accounts. In fact, one of the general rules of reconciliation is that there are no accounts that can't be reconciled. By now, you might be asking, Bianca, isn't reconciliation kind of a part of the accounting cycle we started with? All these types seem like an extension of that. What's going on? I hear you, and you're not wrong. The last step in the accounting cycle we covered was close your books. Closing the books out is definitely a type of reconciliation. You're ensuring all transactions and cash flow have been accounted for on the trial balance, and the journal and ledger are ready for the next month, right? As any bookkeeping boss will tell you, closing the books monthly is the gold standard for maintaining your accounts. Here's the subtle difference between a monthly closeout and other reconciliation types. When they're done. Not every account is closed out each month. In a large company, some accounts are only estimated at month's end, and then the full reconciliation process happens quarterly or annually. Eventually, all those estimates have to be reconciled to ensure financials are correct. As a bookkeeper, you will be reconciling accounts perpetually as a part of monthly close, quarterly reporting, and annual filing. Hey, that's job security, baby. And while software can be your best friend here, you need to understand how the process works. Let's take a moment to hear from a colleague with more insight into this whole reconciliation thing before we dig into the play-by-play.
Reconciliation is so important, and here's why. We can enter any transaction into a financial software or as a journal entry. We can enter whatever we want. However, if it doesn't clear the bank or clear a credit card or clear a loan statement, it didn't really happen. So the point of reconciliation is tying the transactions that have been coded into the books to an outside document that we have no control over. It's usually a financial institution issues a statement monthly or something like that. So we're tying our work to an outside document so the two entities are basically verifying each other. So most people or most bookkeepers are responsible for reconciling cash accounts like bank, like checking, savings, money markets, things like that. Anything you get a statement from the financial institution. Also credit cards, those come through We would post all those credit card transactions and then double check that the balance at the end of each statement matches what the credit card statement says. There would be some other things that you would probably be reconciling every month if there's a loan with an amortization schedule and things like that. Those are typical things that bookkeepers would reconcile. However, there may be other sorts of accounts that will appear on a balance sheet that can be reconciled that we may not have the responsibility to do that. There might be something like stock trades or other investments like that. And just other things that the accountant might just be adjusting at the end of the year. So that is where a good conversation with the CPA or whoever their accountant is and the bookkeeper, it's just great to have that relationship and you guys work as a team. So let the CPA or the accountant tell you what you should be reconciling monthly. And then there might be some other things that they do annually or quarterly or something like that.
I hope you're beginning to see that reconciliation really is about a process used to ensure things are, well, reconciled. Let's walk through the specific steps now. First, compare your internal account register to the external document, a bank statement, for example, for the period you're focusing on. Then ensure all outgoing funds have been accounted for in both accounts. Next, check that all incoming funds have been accounted for in both accounts. After that, check for errors. More on this in just a moment. Make adjusting journal entries, and finally, make sure the balances are accurate, that they add up. Simple, right? Well, yes and no. Reconciliation can be tedious and errors are common. Before we walk through the process with an example, here's a few tips on how to troubleshoot any errors you might find.
So I find that there are some common issues with reconciling. One of the basic ones that I've seen bookkeepers do is they'll reconcile a certain month and check off everything. Let's say they are using QuickBooks for that. They check off everything that has cleared the bank that is on the bank statement. However, there's sometimes remains some transactions that haven't been checked off. And you really always have to ask yourself, why aren't these checked off? If these are older, dated transactions from prior periods and they're still sitting there unreconciled, it means they didn't clear the bank. So you can't just leave them there. You really have to research those transactions before you finalize the reconciliation. It could be that they're duplicates. It could be that that maybe they never cleared. It may be an old check that somebody never actually cashed. So it's worth not just checking everything off on the reconciliation screen and verifying what's cleared. You also have to look at what has not cleared. Now, another common issue with reconciliation is you might see a client who makes a change to an already reconciled transaction, and that could be an issue as well. So you need to be able to go back and verify what they did and fix it. So sometimes your beginning balance may be off as well. So those are two of the common things I've seen. And just make sure when you finalize a reconciliation, there's no odd transactions sitting out there unresolved. You don't want older transactions sitting there uncleared. You need to research them.
You've already learned a lot about the types and process of reconciliation. Let's take a look at what a common bank reconciliation might look like. We're going to use the format you see here. Now, I do want to say that every company will have its own specific processes. So be sure to check in with the CPA or other financial team members for your specific procedures. But typically, a bank reconciliation will run something like this. Compare the amount of every check that was paid by the bank, cleared the bank account, with the amount of every check in the company's cash account. Any differences, such as the outstanding checks and errors, must be shown on the bank reconciliation. Compare every deposit processed by the bank with the receipts recorded in the company's cash account. Any differences, such as a deposit in transit and/or errors, must be shown on the bank reconciliation. Compare other items on the bank statement with the other items in the company's cash account. Any differences, such as bank fees, checks returned because of insufficient funds, collections made by the bank, etc., must be shown on the bank reconciliation. This brings us to step 2. Enter the unadjusted balance from the bank statement. Add any deposits in transit. These are receipts in the company's cash account that have not been processed by the bank as of the date of the bank reconciliation. Subtract any outstanding checks. These are the checks the company had issued and recorded in its cash account, but have not been paid by the bank, not cleared the bank account, as of the date of the reconciliation. Add and/or subtract other items with amounts that were incorrectly recorded by the bank. Combine the above amounts and show the total amount on the bottom line, adjusted balance per bank. Now we're ready for step 3. Adding the book side of the bank reconciliation form. Enter the adjusted balance appearing in the company's general ledger cash account. Add any increases, interest earned, bank credit memos that are shown on the bank statement but were not yet recorded in the company's cash account. Subtract any decreases, such as bank services charges, return items, bank debit memos that are shown on the bank statement but are not yet recorded in the company's cash account. Add and/or subtract other items with amounts that were incorrectly recorded by the company. Combine the amounts on the right side and show the total on the bottom line, adjusted balance per books. We're almost done. Step 4. Recording the adjusted balances, making sure the bank adjusted balance matches the book adjusted balance. Once they are confirmed, you're done. If there were any adjustments made on the books balance, though, they need to be reflected in the company's journal as an adjusting journal entry. For example, if a $25 bank charge was on the bank statement but not recorded in the company general ledger.
So specifically regarding bank reconciliations, they're very important. And I think I mentioned before that it's really important that when you are reconciling, that there are no rogue transactions sitting out there. When you check everything off, it should be everything that cleared the bank account for that month. And if there's anything sitting there, that has not been checked off, it might be a check that's just a few days old that didn't quite make the cutoff of that bank statement, and that's fine. But you don't want to see older stuff sitting there. You need to resolve all of that. The reason why this is so important is cash is king. Your client needs to know how much money they have available. And if you have old outstanding transactions that you've not resolved or gotten rid of or figured out what happened, they really don't know how much cash they have available. And they might know what the bank tells them they have available, but do they really have that much truly available in their checking register? So it's very, very important to make sure your bank reconciliations are clean every month and there's no rogue transactions sitting there for months and months and months unresolved.
While the process is simple in theory, in reality, it can be a bit, tedious and frustrating. Software will help with both of these, and we'll look at that in another lesson. For now, I want to share with you a solid approach, leading with the balance sheet. One of the best practices for reconciliation is to use the balance sheet approach. This simply means reconciling all of the accounts listed on your balance sheet each month. Just like the overall reconciliation process, the steps for a balance sheet approach are simple but can be time-consuming. Let's hear what another expert has to say about this approach.
The balance sheet approach to reconciliation really is talking about the balance sheet itself. You're looking at the balance sheet. It has balances listed month to month, and you want to make sure that each one of those balances has been reconciled or tied to an outside document. The way a balance sheet is interpreted is going to tell the client how healthy their business is. And if those balances are not correct and verified with an outside document, row by row, you really have no way of interpreting that financial statement for them. One way that I've found that the balance sheet approach really works, and that's meaning going through all the bank accounts, all the savings accounts, all the credit cards, all the loans, everything, get through there and make sure everything has an outside document. I found that a client once really didn't tell me that they had a loan on a vehicle. And I got everything reconciled, but then there was something missing. I noticed in the bank that there were payments going out to a loan, and I had to have the conversation with the client. What are you paying for? Is this personal? Is it business? What was it? And then, oh gosh, we were missing an entire auto loan on the balance sheet, which was skewing their ratios as far as assets to liabilities and what their equity was. So it's really, really important to go through row by row through that balance sheet, ask those questions. If there's transactions that you're reconciling out of cash accounts that you don't know what they're for, you really need to dig into that. And maybe you would find a loan or something else, a line of credit that they have that was not on their books yet. So the entire balance sheet tells the entire story. Reconcile it row by row.
Well, now that we know a thing or two about reconciliation, I think we should check in on the dynamic duo and see how they're doing. Hey, Sophia, how's it going? Ready to start reconciling those books?
Well, I think I'm ready now that I understand a bit more about what we're about to do. But what else do I need?
I thought you would never ask.
Okay, so I have all these receipts that I found in the van. Will these do?
That's a good start. But when it comes to source documents, we need to make sure that we have everything.
I was afraid you'd say that.
Source documents are the proof that the transaction really happened. If you have to go back and check an invoice from a vendor, but you don't have it, well, that's a problem.
Got it. So everything means everything.
Now you're getting the picture.
Bianca, I knew it. Your guides led you back to us, didn't they?
Glad to see you too. You need to hear this as well, so make sure you're balanced and have a seat. All right, remember when I said that reconciliation is like a big matching game? Well, before we can start matching up socks, we have to gather them all up and make sure we have all of them. We're going to be teaching these two to match up their own socks too. But before we can do that, it looks like we're going to have to teach them to keep all of their socks in one place, not in a desk drawer or the glove compartment. In the game of reconciliation, source documents are where we find all of the transactions that we will need to verify. Just about anything can be a source document, so let's go over what they are, why they're important, and some examples of source documents. Financial transactions are the basic exchanges between buyer and seller that fuel the business world. These agreements are a form of communication that leave behind a physical and digital exhaust. The resulting paper trails left behind are referred to in the accounting world as source documents. Source documents are so named because they are the original records that prove a specific transaction took place. The ability of source documents to verify that a specific transaction occurred is exactly what makes them so important. Their role in supporting evidence makes them an important part of any business process that involves going through the books. They're useful in conducting efficient bank reconciliations, accounting audits, and for tax filing purposes. Source documents are the backbone of a well-run accounting system and should not be overlooked. Let's hear from one of our experts on the importance of source documents.
When it comes to source documents, it's really a verification of the work. We talked about reconciling verifies it, but if you want to go transaction by transaction, sometimes you need a source document to actually back up the transaction itself. So the best practice for maintaining source documents, you could have a document collector app that could work. You could have your client email you source documents. There are programs like QuickBooks Online that have a document or receipt area where everything can be uploaded into one area and connected to the books. So there's lots of ways to collect those source documents. However, some people still do the shoebox of receipts. I can't say I would recommend that in my practice, but it still can happen, and you can scan those receipts as well. Ways that can be used, well, You can attach source documents in QuickBooks Online to the transaction itself. For instance, if you are doing a payroll journal entry based on an outside payroll program and you pulled the payroll report from that payroll service, you could attach the actual payroll report to the journal entry supporting the debits and the credits that you've keyed in. Another way to do that is, let's say your client took a customer out to lunch to strike a deal and get a contract. Okay, well, IRS is going to want a receipt for that meal and all the expenses, and usually the client would take a picture of it or save that receipt and write a note about what the meeting was about. That source document could be attached to the actual credit card transaction if you were using QuickBooks Online. Another way to use a source document is an auto loan. Loans have an amortization schedule where the interest and principal fluctuate every month. And an amortization schedule is going to show that payment 1 is this much principal, this much interest, and payment 2 is slightly different, payment 3 slightly different. So the source document for that loan would be very helpful month to month for the bookkeeper to make sure the interest and principal split are correct every month. So consequences for not having the right source documents, well, one would be you don't have a backup document for the IRS, you don't have a backup document for the statements and the activity that the bank said happened. And then also, let's say that loan balance might be off because the bookkeeper is just booking everything to principal and no interest, so you don't have an accurate loan balance on the balance sheet. So source documents are very, very important, and I recommend coming up with either an app that collects source documents for you or a program that does, or again, you could do the shoebox, but that's kind of old school, but go for it if you want. Those are source documents. I recommend you keep them.
One often overlooked aspect is document management. What happens when you have poor document management? Shoeboxes. Lots of shoeboxes. Poor document management can create a whole world of grief for you and your client, so be sure to incorporate these guidelines into your practice. First and foremost, the information contained in the source document should be recorded in its appropriate accounting journal as soon as possible. Once the information is entered into the accounting system itself, that source document should be quickly filed away, ideally in a manner that makes retrieval as easy as possible. Document control is important so that needed items are easier to track down. One method for doing this is to pre-number your documents before filing them away. Once the documents are filed away, a set of internal control procedures specifying who has access to the documents, as well as the chain of custody required to ensure preservation of the source documents, is important as well. There might be certain mandates in place specifying how long source documents must be kept, usually about 5 to 7 years, but generally, a company will set down its own policies. Keeping source documents around longer might prove useful in the event of a lawsuit or just as a way to gauge internal metrics. Generally speaking, photocopies of source documents are legally acceptable, as long as they are readable and contain all of the information provided in the original. In many cases, photos, PDFs, and e-forms are also acceptable, making the digitization of existing source documents an important consideration as well. A good document management system is a kind of insurance against the unforeseen. Most companies also have document retention policies that dictate how long certain records need to be preserved. Let's hear from one of our experts about the importance of maintaining source documents.
It's really important in your bookkeeping practice to have a system for sharing and storing source documents. This could be bank statements, it could be receipts, it could be amortization schedules, all kinds of things. It could even be a purchase contract for a new vehicle or something like that. Anything that's going to affect the balance sheet or the profit and loss, either on a transactional basis or an overall balance month to month. I personally use QuickBooks Online for Everything, which has a receipt capture system and a way to share documents with my clients. So that's personally what I use. There are also lots of apps out there that you can use to collect docs with your clients. Or you could even use something like a Google Drive folder and share that folder with the client and have them upload documents from there. The one thing I do want to recommend, though, is that you have a naming convention. Sometimes people take a picture with their camera of a receipt and send it to you, and it's got this string of numbers and letters that make no sense to anybody. And when you add that to a folder or a document sharing system, there's no way of knowing what that document is unless you physically open it. So come up with a naming convention. It's a receipt, it's a statement, it's whatever it is, and then maybe a date, amount, I don't know. But you need to come up with some sort of system so that your documents are very easy to look up, no matter what system you use to share documents with your clients.
You've been learning the basics about the reconciliation process in general, but you'll be happy to know that QuickBooks Online can do that too. You'll be learning more about how to perform a bank reconciliation later on. But before we get there, we'll need to do a little preparation first. There are two ways to feed the bank transactions into the system. The first is to manually upload all of the transactions yourself. The other way is to connect your business bank account directly to the system. This is faster and more efficient. Take a look at the system demo video to learn more.
This is Karen from the QuickBooks team. Connecting your bank and credit card accounts to QuickBooks is the fastest way to accurately record your company's financial transactions. Let's go over how to connect a bank or credit card account to QuickBooks and choose how far back you want QuickBooks to pull your transaction history. To get started, select the Banking or Transactions menu. There are two ways to bring in transactions from your bank and credit card accounts. The first option is to download your company's historical transactions from your bank and credit card in a file. Then you can upload that file so QuickBooks adds those transactions to your accounts. If your bank doesn't have the option to connect your accounts, you can usually still get a file and upload transactions manually. However, keep in mind, you need to upload a new file every time you want to bring in more transactions. The second option is to connect your bank or credit card so QuickBooks downloads your transactions automatically. Let's connect an account. Select your bank or credit card from the list of popular financial institutions. Or enter the name of your bank or credit card company and select it from the list. You'll need to enter the username and password you use to log into your bank or credit card's online banking. Each bank and credit card has its own security features and may require a few more steps. Once you've finished with your bank or credit card sign-in steps, QuickBooks looks for all the accounts you have with your financial institution. Select each account you want to connect. Note that you don't have to select everything you see. You should only select the accounts that are relevant to your business. If you see a personal account that isn't business-related, you can leave it unselected. At this point, QuickBooks will connect your online account with one from your chart of accounts. If you've already set up the account on your chart of accounts, you can choose the relevant account from the drop-down menu, or choose the kind of account you want QuickBooks to create for you. Once you've selected the accounts you want to connect, you need to choose how far back you want QuickBooks to go when it downloads transactions from your bank or credit card account. The default choice is the beginning of last year. Many businesses want to bring in transactions from just the beginning of the current year. If you don't see the option you want, select Custom and enter the date. When you're ready, select Connect. Once the connection is complete, you'll see all your business transactions that cleared your bank or credit card from the date you entered to today. When more transactions clear your bank, they'll appear on this list for you to review. The next step is to categorize them so QuickBooks adds them to the correct accounts. Follow the link at the end of this video to learn how to do that. Now you're ready to connect your bank and credit cards to QuickBooks Online.
All right, you two, listen up. Tax season is upon us, and it's time to get serious. We need to reconcile your books. In order to do that, we will need to gather up all your source documents.
Got it. So, what exactly do you need?
Let's start with the bank statements. You never know what we may need to refer back to, so we're going to need everything.
Are you serious? Everything?
You heard me. Everything. Leave no massage oil vial unturned. Gather up everything you can find and report back here immediately. Let's get to it.
Summer, this is insane. There are so many documents here. How could you not organize these?
Hey, you told me to keep the receipts, so that's what I did. I didn't know that you wanted me to alphabetize and collate them too.
It's never a dull moment with you two, that's for sure. Sophia, it looks like you got everything you need to start your reconciliation, yeah?
Yeah, I think so. But man, this is a ton. Is it always going to go like this?
Well, I'm not gonna lie. This first one is gonna be pretty involved since you've never done it before, and your source documents were all over the place. But going forward, I'll show you a couple of methods of reconciling that might make things easier.
Oh, that would be great.
You know, because Summer and Sophia have been putting off reconciling their books, they're going to have to do a lot of legwork this time around. But the good news for them is that, going forward, if they reconcile frequently, it will be a lot less of a headache. Now, from a bookkeeping standpoint, there are really two methods of reconciliations: the report review method and the transactional review method. Depending on the account that you are working with, you may use either one of these. So, before we get too deep in the weeds, let's hear from one of my experts.
It's really important to develop a relationship with your client's CPA or accountant. And there's several reasons for that. We first of all want to work in tandem with them. We want to make sure that we are not overriding something they're going to do, and there's a complete conversation about who is doing what. And what's really important is to know what exactly they're expecting you to do in that chain of work or chain of command. So usually it's the monthly reconciliations of banks and credit cards and loans and things like that. They probably want you to have you go through and look at transactions, make sure they're coded properly. I usually meet with my clients and go through that month to month and make sure that everything had been coded to the proper accounts. Ask them. Don't be afraid. Don't feel like, oh, I don't know. I'm not sure what to ask or what to do. Just be really upfront. Just say, I'm going to be doing this, this, and this. Is there anything else you want me to do? Is there anything else that I can help you with or take off your plate? It's just really important to know what they are going to be doing and what you're going to be doing. And in some cases, what the client's going to be doing. And you guys are all working as a team. And don't be afraid to ask questions and outline exactly what your scope of work is going to be.
Okay, let's get our hands dirty. The report reconciliation allows companies to compare amounts listed on source documents to the total listed on the balance sheet. Now, this isn't something that is used for every account, but for things like accounts payable and payroll, where going through every transaction can be a headache. The report reconciliation can simplify the task. On the other hand, with accounts like a long-term note, if the balance is off, you'll likely know that it is an issue with either the principal or interest payment. By using a report reconciliation, you save yourself the time of having to go through line by line. Just fix the transaction and you're done. Now, from a reconciliation standpoint, there's some benefits to using the report reconciliation method. However, since this method is a bit more high level, if the accountant finds an issue, you may still have to dig into the books to determine what the issue is. Now, I know that was a lot to take in, so before we look at the report reconciliation process, let's get a few tips from an expert.
In some cases, reconciliations have to be done without an outside source document, meaning something like a bank statement showing the ending balance at the end of the month. A good example of that would be accounts payable. Accounts payable is a series of open bills that have not been paid. There's really no outside source document that says, okay, accounts payable issued by some outside company telling you what bills you haven't paid. Nothing to reconcile to. So that transactional reconciliation, the traditional one that we've been discussing, really doesn't come into play. So what do you need to do? you need to actually, it's called a report reconciliation. You're going to run the accounts payable report. You're going to look through those open bills with your client, and you're going to verify that they still are truly not paid. So it's more of an overview, a look through the activity for the month to make sure it's still reporting accurately. And it works the same with accounts receivable and things like that. You want to go through the report itself with the client and just verify everything's correct.
The other reconciliation method is called the transactional reconciliation method. This will be the type of reconciliation method that you will most likely deal with as a new bookkeeper. This process consists of going through the books line by line, source document by source document, to make sure that every transaction syncs up and is accounted for. Now, because you are looking at every source document for every transaction, this method is a very detailed process and gives you a microscopic view into the financial working of a business, which is a good thing. However, depending on the size of the business, going line by line is extremely time-consuming and can lead to delays producing financial statements at the end of a reporting period. Just think of how many business transactions a company the size of Intuit has every month. That's a whole lot of source documents. Here, let's sit a spell and hear from one of our experts.
Another type and more common type of reconciliation is transactional, which basically you are comparing from an outside document to the books, row by row, transaction by transaction, to make sure both the statement and the books have the exact same transaction recorded. So that is transactional. You usually, if you're using an accounting software, you're going to check off each transaction that has cleared the bank. And hopefully, when you're finished with that reconciliation, the cleared balance in the books will now match the cleared balance on the bank statement at the statement end date. Some things that bookkeepers can get confused with that is if there's extra transactions sitting there unreconciled. Those should definitely be looked at before finalizing a reconciliation, just to ensure that there's no duplicates. Or if there's something missing, there's something on the source document from the bank that is not in the books, it needs to be coded in there and posted. So make sure that everything that's on the statement is in the books. That is a transactional reconciliation, and it just ensures that all the work you've been doing all month is completely accurate and verified with an outside document.
Now, like I said, the transactional reconciliation method is a pretty detailed and time-consuming process. Luckily for you, we live in the 21st century. That means that you will likely be using accounting software like QuickBooks to do most of your bookkeeping work. Here, let's take a look at how to do a bank reconciliation using QuickBooks Online.
Hello and welcome to this video demo of the new Reconcile experience available in QuickBooks Online. To access Reconcile, go to the gear icon at the upper right, then select Reconcile. That will launch the new Reconcile landing page. First, I will provide a quick overview of what exactly a reconciliation is and its benefits. Reconciling an account is important because it ensures that what you have in QuickBooks Online aligns with what really happened in the account. That enables you to accurately monitor the flow of money in and out of your business, and also ensures your books are accurate for when you file your taxes. This is done by comparing the statement you receive from your bank or financial institution with what's in QuickBooks Online. Today in this demo, I'm going to be reconciling a credit card account, and I also have my credit card statement out to complete this reconciliation. The first thing you want to confirm is the beginning balance matches with what you see on the statement. And then you proceed by entering in the statement ending balance off the paper statement. And today we'll be reconciling the January statement period. Then click Start Reconciling. And this is the new Reconcile page. I'll highlight a few of the enhancements. Beginning with the upper left here, we have a link to the credit card register. So with one click now you can access the accounts register. Below that, you have a filtering option that gives you a number of ways to locate hidden transactions. For example, you can search by memo, reference number, dollar amount, or you can filter this table down to a particular transaction status type, transaction type, payee, or filter the table down to a more narrow date range. At the top middle, by default, it'll show all transactions, but you also have the flexibility of filtering this table down to only show payments or only show charges, and easily toggle back and forth. With this particular credit card account, it's connected with an online banking connection. So with that, the majority of these transactions, since they were downloaded, are already ticked. Transactions that aren't ticked were manually entered, and for whatever reason we don't have a matching transaction from the bank. And at the upper right, it'll detail how we're progressing with the reconciliation. With all these transactions ticked, we have a difference of $55. Our goal is to get this down to $0. You'll notice as you untick or tick, all these totals will change. If you're getting down to the end of the reconciliation and you're having trouble getting down to a $0 difference, a number of tools to help you get to zero. First, we do provide a total for the number of charges and total number of payments, and your bank statement will provide the same. So you'll be able to compare these totals against what you see on the statement to see what you're missing. You also have an option here where you can expand this area to have more visibility on how you're getting to this $0 difference. It'll highlight the statement ending balance, the cleared balance, etc. And you can always collapse it to view more transactions. You also have a number of ways you can filter or sort this table, not only from here, but you can also sort these columns just by clicking on the column header. But as you locate transactions that need to be ticked, we're getting close to zero, and now we're down to a $0 difference, so we're done. At this point we can click on Finish Now, and that will provide a way to either view a reconciliation report or select Done. And you can always access reconciliation history from the Reconcile landing page by clicking on Reconciliation History. And that'll launch a report that'll detail all the different accounts that are subject to reconciliation. You can specify the date range and view or print reports here. Sometimes your account may not be ready to reconcile right off the bat. If your beginning balance doesn't match the ending balance of the prior reconciliation period, it's very important that you fix the beginning balance prior to reconciling the next statement period. The next account I'm going to reconcile is also a credit card account. And you'll notice we have an alert that our beginning balance does not match the ending balance of the last statement period. We now provide the tools to help you easily and quickly locate the problem transactions to correct this beginning balance. And it's done with a reconciliation discrepancy report. So if you click on this link, that'll launch the report, and I'll highlight a few things here. It will detail the transactions that are causing the discrepancy. In this situation, we have 2. Our goal is to get this down to a $0 discrepancy. And in some situations, you may want to investigate what happened with these transactions. And over on the right, you have the option to view a transaction audit log. That'll launch in a new tab, and it time and date stamps the history of changes to this transaction. So you'll be able to see who made the change, when, maybe figure out why it was changed. And once you've determined how you want to proceed, you'll be able to go back to the discrepancy report. And we'll notice with this $100 transaction, it was previously reconciled, but now it's in an unreconciled state, creating a $100 discrepancy. And we've determined that this should be marked as reconciled. So if you click on the transaction, it'll expand and give you ways to modify it all from this report. And notice what happens once we remark this as reconciled. Our difference at the upper right will automatically adjust. So now we're down to a $9 discrepancy. We're getting close. For this remaining transaction, looks like the amount was changed. It's still in a reconciled status, but it was changed by a difference of $9. And with this particular transaction, we can either modify the amount within this field here, right-click on Edit. That'll open up the full transaction, and you can modify the amount here. Either way. Save and close. Since this is a reconciled transaction, we will alert you that you're modifying a reconciled transaction, and that may create a problem. In this situation, we know we're on the right track, so we can just disregard it. And now the report's gone. The alert is gone. Our beginning balance is now correct. And now we can proceed with reconciling the next statement period.
Whew! I think I'm done reconciling my books.
Well done, my girl. This looks great. And you were able to get everything down to that beautiful zero balance. I think you are ready for tax season.
Seriously, Bianca, thank you. We would have been in a real bind if it weren't for you. You are a regular bookkeeping Mary Poppins.
Just a spoonful of reconciliation helps the account stay accurate.
Oh, Bianca, you are something else. I'm really gonna miss you.
Don't I know it? You two take care now, and remember to make sure that you are keeping up with your books and reconciling frequently. All right, I think it's time I'm on my way. Goodbye, my dears. Well, here we are at Crankshaft Customs. I'll never forget the smell of exhaust and oil like it was yesterday. In fact, I think I still have some grease stains on my skirt that won't let me forget this place. It's all right, though. I like Xavier and really enjoyed seeing him learn and expand. Didn't you? Come on, let's see how Xavier is getting on these days. You have been working so hard, keeping up with all your bookkeeping. Everything is in order and looks great.
Well, thanks for that, B. Means a lot coming from you. Everything seems to be going okay. My software says things are balanced. We have some money in the bank. I'm able to pay my vendors and employees. But I guess I don't really know what it all means and what to do with all this information other than to give it to Jerry for my taxes and apply for loans.
Oh, Xavier, this is where the good part begins. You've been doing great keeping up with your entries and doing them correctly. This means that as you go along, doing your business and entering your bookkeeping info, you can make adjustments and changes so that your business can become more profitable.
Oh, I like the sound of that. And I was already thinking of other ways we could expand, but wasn't sure if we had enough income yet to do it. Can you help me figure that out?
Well, I'm happy. No drama means no drama. We'll show Xavier how his correctly entered bookkeeping information can help him, and we'll start with what every business owner wants to see, the bottom line. I'm talking about the income statement, also known as the profit and loss statement. Well, aren't you just a little bit relieved that most of that was already familiar? Like hearing that song you liked from high school on the radio? It's a nice surprise and brings back memories of days long ago. You've come so far since then. Let's not stop now. Let's say your client wants you to pull an income statement, looking over the past 3 years, so they can do some analysis on how things are trending. Would you know how to do that? Naturally, software makes this a breeze. How about I get a friend of mine to walk you through it?
So most accounting programs should have the ability to pull a profit and loss statement. I'm going to demo really quick where to find that in QuickBooks Online. I'm in Craig's Design and Landscaping Services, which is Intuit's demo company for QuickBooks Online. This is a great company to experiment in. But I'm going to go to the reports on the left navigation. And at the top here, we have some favorites already bookmarked. And you can click profit and loss really quick. If you scroll up, you can see there's settings for date range and other things. So this is the profit and loss report. I've rerun it for this year, showing income, cost of goods sold, expenses, and then of course the bottom line, which is their net income for the year. So that's how you run a profit and loss statement in QuickBooks Online. Like I said, all the other accounting programs will have a similar report ready for you. So occasionally your client may ask you for a profit and loss statement. Why would they ask for that? Well, basically people want to know whether they've made money or not. And in some cases, it could be, how do we do last month to this month, or last quarter to this quarter, or last year to this year? They want to see trends. They want to be able to do analysis on income, costs, and expenses and compare different periods. And in some cases, they just want to know the bottom line of a profit and loss, which is, did we make money or did we not? So those are some reasons why a client might ask you for the profit and loss statement. You do need to be aware that you can run the profit and loss statement either on an accrual basis or a cash basis. On an accrual basis, the income and expenses will show unpaid bills and unpaid invoices in those totals on those rows in the financial statement. So even though the invoice hasn't been collected, it's showing as income on the profit and loss on an accrual basis. And even though you haven't paid that electric bill, but it's entered as a bill, it will show as an expense on that profit and loss. So accrual basis will include receivables and payables that are unpaid. The cash basis means exactly that, cash. It'll back out any unpaid invoices and unpaid bills and actually show on a cash basis, money in, money out, what was brought in and what was spent. So that's just a little bit more about the profit and loss statement and why your client might want to take a look at it.
Now, simply pulling reports is a great help, but it's not the end of the road as far as what we bookkeepers do with these financial statements. We also have to be able to interpret those numbers for our clients. Xavier is counting on us to be able to explain this to him, so we better know ourselves, right? To do that, I'm going to throw in a formula you'll use to help compare numbers, just to spice things up a bit. Don't say I never gave you anything. It's called the percent change formula. It's used specifically to compare changes between 2 years and looks like this. Let's work through an example together. You can see the 2 years side by side on this P&L. Let's calculate the percent change of net sales, so we'll know how much change occurred. First, we take the net sales number from 2017, subtract the net sales number from 2016. Then, we divide the difference by the net sales of 2016, multiply by 100 to get the percentage. In this case, after working the equation, we get a percent change of 6.3% increase from 2016 to 2017 net sales. And in case you're wondering, yes, you can get a negative percent change as a loss. Remember, this is a profit and loss statement. Okay, you've got that down like a boss. Let's jump into the two methods I mentioned earlier that will help us explain these changes to Xavier and our other clients. First is horizontal analysis. Just like it sounds, you're looking at the numbers going across each line and comparing the changes over time. This is helpful for spotting trends, especially for line items. Changes over time can be expressed as a percentage, like what we just did, or in dollar amounts. The only difference here is that you might be looking at multiple periods, not just two. The second method is called, wait for it, vertical analysis. Now, this method not only means reviewing the numbers across vertical columns, but specifically uses percentages. This makes it easier to compare periods within the company, but also across other companies of different sizes. Each line item on the financial statement is presented as a percentage of the base amount. On the income statement, sales or revenue is the base amount. On a balance sheet, total assets is the base amount.
So another way to look at a profit and loss statement with your client is to actually take the year and do columns by month. And the reason this is important is you want to be doing an analysis of month by month. What was rent? What was utilities? What was telephone? Payroll, all of that. When you do columns by month on a profit and loss, you can easily see with the client if something has been maybe not dated correctly. So it could be that they paid their rent on March 31st rather than April 1st. So they coded the money out transaction to the month of March. When you do a spread of that profit and loss statement month by month, you can see easily that rent was double booked in March and there's no rent in April. So it's a great way to help your client look at their data, make sure month by month everything's trending and expenses are looking the same across the board if that's what they're expecting. And it also helps your client interpret what's going on with their business. So spreading that out and doing those horizontal columns can really help your client understand how their business is doing.
You might be thinking at this point, much like Xavier, this is nice, Bianca, but what exactly does all this tell me? Let's say your client runs a retail shop that specializes in costumes and formal wear. What? You've never heard of themed weddings before? I know. Just go with me here. Can you guess when sales might be up versus down over the course of the year? Could you guess why these trends may be? Comparing your P&L sales horizontally over the year will help you spot those trends for your client and understand which seasons tend to boost sales and when sales typically slow down. A vertical analysis of the same periods will help you dig further into what percentage of your line items are helping or hurting you the most. Reading the numbers in this way will help you guide your clients to ask more questions and consider things like seasonality and products and services that are costing more than they're bringing in. As a bookkeeper, you might be the first one to notice these trends. Your clients will often ask you what these numbers mean, not just what they are. Let's get a colleague of mine to elaborate on these concepts.
So when looking at a profit and loss statement, I always, with my clients once a month, go through it row by row to just double check that everything for the prior month has been coded properly. The reason this is important is, as you know, income is stated on the profit and loss, and it could be that your client is tracking income separately for services or products or different types of things they sell. So they might have multiple types of income listed on that profit and loss statement. Looking at this row by row and making sure the income sources were coded to the proper account on the chart of accounts is really, really important. You want to make sure that not only income, but cost of goods sold and expenses on a monthly basis have all been coded properly, so that when they do decide to look at an analysis of their profit and loss for the year, maybe this year compared to last year in columns, they can see the trends and what's going on. Did they do better this year? Did they do worse? And then they can drill into the different types of income or expenses and actually see what the source transaction was and maybe interpret why they made less on a certain type of product, etc. So it's really important that you have that monthly meeting with your client and go through this information. Although you may do it quarterly with your client, it depends on your contract with them. But it's so important to go month by month so they fully understand where the money came from, where it was spent, and then they can start forward thinking about how they're going to do better next month or next year and start planning for the future. So it really, really helps to help them understand all of these rows and columns on their financial statements.
Now that you've mastered reading and interpreting the income statement, we can get back to Xavier and walk him through this. It'll be good to see how his business is trending. Heck, Xavier may not understand how cool it is to be trending at all. At least business trends on a P&L don't affect my hairstyle or wardrobe. Funny how things come back around, isn't it? Maybe I'll be glad I hung onto those pink parachute pants after all. So that's everything you need to know about reading an income statement.
Got it. Thanks for your help.
If you've got any other questions, just let me know.
Will do, thanks, B. I think I've got a handle on that one.
Perfect. What's next then? There's other financial statements, you know. Don't just look at that one.
Yes, ma'am, will do. So I wanted to ask you about this one, too. The balance sheet.
Done. Let's get to it. Xavier is on a mission, isn't he? Well, I love it. He understands that being able to read and interpret the financial statements won't just help him keep his books balanced. They'll help guide him as he continues growing his business. Like a map, these financial statements help a business owner steer their business to more profitable waters. As they do that, they'll occasionally need help from you reading and interpreting these maps. If the business owner is the captain, you're the one manning the big wooden steering wheel. They still have those, right? So it's important for you to be able to read these maps as well. The ability to read and interpret the financial statements is a fundamental skill that will serve you well throughout your bookkeeping career. There are a couple of reasons for that. We've got a model client here in Xavier. He's a real go-getter and not shy about asking the questions he needs to solidify his understanding. That's normal. Clients will always have questions. That's actually a good thing. Most of your clients will not know how to read a balance sheet and will need your help. More importantly, learning to read and interpret a balance sheet will help you pick out potential trouble spots as well as recognize trends in the data. This information will be useful when analyzing a balance sheet to answer a client question or solve a problem. We'll get to analyzing stuff later, though. The ability to read and interpret is the foundation on which you'll be able to analyze the statement. For now, let's listen to an expert as they talk more about reading and interpreting.
So it's really important that we at least know how to understand and read a balance sheet. Sometimes our clients might have questions about how much cash do we have, how much do I still owe on that car loan, etc. So we want to make sure that all those balances are correct by doing the reconciliations every month. But then we want to be able to pull those reports, the balance sheet in particular, to get them the information they need. Maybe they're going to refinance a loan, or maybe they're going to get a new truck and trade one truck in and get another one. So we need to have those answers for them really, really quickly. So common questions the client might have are exactly what I just said. How much money do I have in the bank? What is my credit card debt? What do I owe in loans? How much money did I draw out of the business this year? Those are things that we just need to be able to open up that financial report and see that and get them that information, especially if they are at the bank trying to negotiate some business, or maybe they're getting an investor in their business and their new investor wants to know how much debt they have versus cash and assets. So if you don't have the correct balances on there and you issue a balance sheet that doesn't have all the loans and all the assets and everything on there, it could be giving a misleading interpretation of that company. So it's really important that we have these conversations with our clients and make sure that everything's listed. All their equipment and furniture and loans and lines of credits and every credit card that is business related, they all need to be on there. So it's just really important that you look at the balance sheet, you look at it every month, and also double check that there's not negative balances in the bank account, or you're showing a debit balance or a credit balance where you shouldn't be. Really important to look at that. And did they overpay the loan? What happened there? So you want to make sure you're not seeing negative balances as well. Just keep an eye on it and hopefully get everything you can on there. It's really important to have that conversation with your client and go row by row through that balance sheet.
Let's do a little balance sheet review, shall we? The balance sheet, also known as the Statement of Financial Position, is one of the key financial statements. The others being the income or profit and loss statement, the statement of cash flows, the statement of retained earnings, and the statement of stockholders' equity. The balance sheet is a snapshot of the financial health of the business at a given point in time and shows the current position of the company's assets, liabilities, and equity. The balance sheet is a reflection of the accounting equation and is referred to as a balance sheet because both sides of the equation must balance. Always. So there you go. That's the balance sheet, sir. Got any other brain busters?
Oh, so it's a challenge you want then?
Oh, that's what I'm here for, buddy. Shoot.
Well then, all right, smarty pants, I've got one for you. So this is what it says on the balance sheet then. Am I right?
So far, you're batting 1,000.
All right then. Well, it says something different on the other one. Hold on, let me find that again. Where is that thing?
You see this, buddy? This is me rolling up my sleeves. Let me know when you find it.
So my profit and loss says I have this much income, but my balance sheet says I have this amount in the bank. What's the deal with that? Where's the rest of my money that I know I earned this year?
Pump the brakes there, Xavier. Let me show you exactly where all your cash is going to and coming from. It's time for us to look at a little report I like to call the Statement of Cash Flows. Now, I'm going to be really honest with you. Most of my clients, you know, those amazing business owners who are already juggling 100 responsibilities, they are not very interested in me handing them a statement of cash flows. If I did, they'd give me a funny look and ask if I was feeling all right. I don't blame them. It can get a bit complicated. But that's where we bookkeepers come in. We do care about this statement. It allows us to understand how cash is flowing into and out of the business so that we can relay that information to our clients. If they made a $100,000 profit last year, but are only seeing $50,000 in the bank, we use the statement of cash flows to explain where the other $50,000 went. That information will help them decide if they want to make changes to the way they are running the business, like sell equipment or take on new debt. You may have noticed some amounts listed on the statement of cash flows are positive and some are negative. Positive numbers represent money flowing into the business. Negative numbers represent money flowing out of the business. Let's take a look at a few examples. Say you purchase $500 in inventory using cash. Bye-bye $500. That's cash flowing out of the business. Next, you take out a $4,000 loan. That borrowed money is cash flowing into the business. Oh, look, tax time. You have to pay $600 in sales tax payable. Cash outflow. But look here. One customer paid $2,000 in advance of service. You have some deferred cash revenue there. Cash flowing in. But it's payday, and you have an outflow of $900 in payroll expenses. You purchased $500 in inventory on credit. Later, when you pay off the credit, there will be a cash outflow. And when you sell the inventory, there will be a cash inflow. Nicely done! Now take a moment to check in with one of our bookkeeping colleagues for some tips related to explaining cash flow to business owners.
So the statement of cash flows is an important tool that allows us to understand what has been happening in the business related to the cash and how it is generated and how it is being used in the organization. There are two main methods of cash flow statements. One is the direct method, where we pull together all the various cash receipts and cash payments and summarize it. And then the one that's probably more common is going to be the indirect method. You start out with net income and you make adjustments for various financing and investment activities, and then come up with that net cash flow. Now, as we're looking at that, obviously, the reason that those adjustments are going to be made, or perhaps maybe not as obviously, but the reason those adjustments need to be made against net income is when we're looking at a business, we typically are looking at a business's financial statements, their income statement, balance sheet, and cash flow statement in the accrual method. That is, of course, the method of accounting where we are recognizing income when it is earned and expenses when they are incurred. So I may have an expense today, but not actually pay it for another month. In an accrual-based method, I'm going to recognize that expense today, but I need to know that in a month, I've got to have the cash to pay for it. So accrual-based accounting is generally accepted accounting principles. It is GAAP. That is how we would look at it. So when we look at our net income, our income minus cost of goods sold gives us our gross profit, minus the expenses to operate the business, and we get our net income. That does not reflect whether or not that cash has been received yet. We could have a really large accounts receivable balance. So even though our sales are good, our cash flow is terrible because we haven't collected the money for it. So when you are looking at a cash flow statement, you're going to see that we need to account for things like that. So when we see our net income, but we see that there has been an increase in accounts receivable, then we need to adjust our net income for that. If we see that our accounts payable has greatly increased, we've counted those expenses and taken it out of our net income, then we see that there's a large accounts payable. Well, we've got to adjust for that as well because we still owe that money. So that adjustment still needs to be there. So there are changes like that. There could also be an investment in inventory. And so we need to account for that. That is not showing up in our net income statement or in our income statement, because it's not there until the items are sold. But if we have invested and increased our inventory, then the cash outlay for that inventory needs to be accounted for on that cash flow statement, as well as when we are increasing liabilities or taking out loans or doing other types of activities that are going to be showing up on the balance sheet. So that is what you're going to see as you're looking through a cash flow statement. Again, the big thing that we want to think about here is, how is the company managing its cash position? And so we need to make sure that they have the cash to pay for the debt that they have, and of course, fund its operations. That is what we're looking for as we are reviewing that cash flow statement. And so again, you're going to see cash from operating activities, which is typically your income statement showing there, and then from investment and financing activities and so on. So those are the big pieces of it. And so I hope that helps you as you are looking and reviewing your cash flow statement, and are able to help our clients be able to really understand their cash position, and then of course be able to do something about it as they start looking at the various pieces of it and how they interact and work with each other.
So, what's the big deal with the statement of cash flows? Well, as you can see, tracking cash flow matters because there are certain obligations for which you need cash, like paying taxes and employees. Do you think your employees will accept leftover inventory or an IOU note in place of a paycheck? No way. They want cash. If you have steady income, but it's mostly credit sales, paying cash for inventory may leave you dangerously short of cash on hand. And bonus, remember how we were able to run a profit and loss and balance sheet in QBO? You guessed it. Our accounting software can also help us easily run a statement of cash flows for a particular accounting period.
Okay, I've got it now. All those things like buying a used truck with cash, withdrawing money from the business to pay myself, and taking out the loan impacted how much cash I ended up with in the end.
I couldn't have said it better myself, Doc. Lou, how's my favorite landscaper doing?
Bianca, well, butter my feet and take me ice skating. How are you?
Oh, Lou, you always did have a way with words. I'm doing great, but more importantly, how are you? How's the business?
Things are going great. After we landed that apartment complex job, 3 more complexes hired us. Now we're busier than ever, booked solid through the rest of the year.
Lou, that's great. So, I gotta ask, how are your books looking? You didn't go back to your shoeboxes, did you?
No. I've been keeping up with them. I got a new system. Everything gets entered right away, and I even reconcile my books every month. I don't want to incur the wrath of Bianca again. One thing that has been bugging me, though, is... Yeah, never mind.
What is it, Lou? You know you can be straight with me.
Well, you know, when things were smaller, I had a pretty good idea how my business was doing from a money-making standpoint. But now that things have grown, I just don't feel like I know how we're really doing. I mean, I got money in the bank, but I just really don't know if we're doing as well as we should be doing, you know?
I get that. It can be tough to stay on top of everything as you grow. Have you taken a look at your income statement to check your profit margins?
My what? I thought the income statement was just, for taxes and stuff.
Oh, Lou. Looks like we should get the band back together. You know, there are a lot of business owners out there that don't realize the amount of information they can gain by analyzing their income statement. Like Lou, most just see it as another form that they have to do for tax purposes. But hey, that's why they have bookkeepers like us. Now, in the bookkeeping world, we sometimes use what is called ratio analysis to look at the income statement to get a sense of not just how profitable the business is, but also to determine how efficiently the business is operating. The beauty of digging into the income statement this way is that business owners can use that information to help them make decisions regarding things like pricing of goods and services. Look at where their areas of profitability are, and even determine where they could cut costs if needed. In other words, by using ratio analysis, a business can get a peek at the gears that are driving the business. One of the more common ratios that you'll use is the gross profit margin. In layman's terms, this shows you the amount of money your client is making per dollar on every sale of a good or service, before you factor expenses or taxes. Essentially, it shows if a business is getting a reasonable return for what it's selling. Now, from a business owner standpoint, when they know the gross profit margin, they can determine if what they're making per dollar is in line with what other similar businesses are making. If not, then they can start thinking about how they make adjustments. So, how do we calculate a company's gross profit margin? Well, I'm gonna show you. First, we need some numbers to work with. Here. Let's use my friend and client, Claire. Now, here's a recent income statement that I whipped up for her. Now, to figure out Claire's gross profit margin, we need to subtract her sales revenue from her cost of goods sold, and then divide that number by the sales revenue again. That should give us the percent of every dollar that she keeps as gross profit. Here, let's take a look. Based on our ratio formula, it looks like Claire has a gross profit margin of 65%. Not too shabby if you ask me. I know that's a lot, so let's hear from one of my experts.
Gross profit margin. What makes that up? Of course, that is income minus the cost of goods sold, or revenue minus cost of goods sold, gives you your gross profit margin. This is a really important number for a lot of businesses. So if you imagine a retail store as an example, you have sales minus the cost of those sales gives you your gross profit margin. A lot of industries are going to have some type of percentage or ratio that they're looking for. They might be looking for 30% or 70% or 50%. That's a really important number for them because it lets them know if their sales are high enough, if they're discounting too much, all of those types of things, or perhaps their inventory is costing more than they anticipated when they're selling. So that gross profit margin is a really important number. Now, for a retail store, that they live and breathe on that. In a lot of industries, they know that really well. But there are some industries, especially service-based industries, that might be really important for them to understand as well, especially if they are using contractors to help serve those clients, or if they can attribute some of their labor costs directly to the delivery of those services. That number could be really important for them and something they've never tracked before. That can be a really big value that you add to that client as you're explaining that to them, so that they understand that they too have a gross profit margin. If we had no clients whatsoever, our gross profit would be zero. If we have no sales, there's no cost of sales. Therefore, your gross profit margin is zero. And then everything below that is their overhead. It is the things that keep the doors open, virtually or literally. And so understanding that is really helpful. And of course, having just gone through perhaps a global pandemic and they just had to keep their doors open, that is a really important number that a lot of clients are looking for. So again, that gross profit margin is sales or revenue minus the cost to produce those sales or revenue. That is your gross profit margin. Then the rest of that profit and loss statement is going to be their operating expenses. And that's really, in many ways, their overhead that gets them to their net profit.
The next ratio that you'll likely use in your role as a bookkeeper is the operating profit margin. Like the gross profit margin, the operating profit margin tells you how much money the business makes per dollar of revenue it generates. However, this ratio focuses on the money that was made after the business expenses are factored in. By knowing this margin, a business owner gets a better understanding about how things like overhead and other operating expenses impact the profitability of their company. If profitability is low for their industry, then the owner can start looking at their expenses and start to work to find areas to cut costs. Now, there isn't a business in the world that runs without some sort of operating expense. So let's take a look at how to calculate the operating profit margin. Let's take a look at Claire's income statement again. To figure out her operating profit margin, we simply just take what her total operating earnings were before taxes and divide that by her sales revenue. That will tell us what percentage of every dollar Claire keeps once her overhead is factored in. Let's see how things shake out. Looking at the numbers here, this means that once Claire pays her operating expenses, she is keeping roughly 38% of every dollar as profit. Still a pretty solid number. Let's set a spell and get some advice from our expert.
So we've discussed our gross profit margin. So now what is the operating profit margin? The operating profit margin is going to be the gross profit margin, revenue minus cost of sales, is your gross profit margin. Now we have all the expenses that we keep up with that actually help us keep the doors open. Utilities and overhead, payroll, professional services, dues and subscriptions, all of those other types of expenses subtracted from gross profit margin gives you the operating profit margin. Again, there could be ratios and numbers, percentages that we're looking for to hit either seasonally or overall through the year or for each month. And so those are targets that we want to meet. It is extremely important that there should be some profit at the end of the operating profit margin and not an operating loss. So we definitely want to see that there's a profit and a percentage that they are hoping for or that they need to get to be able to meet the business needs. This explanation, understanding how to look at their profit and loss statement, looking at these margins where they are seeing a gross profit margin that they're trying to hit and an operating profit margin that they're trying to hit is one of, I think, the most important things that we as bookkeepers can do for our clients, because it is something that many of them do not truly understand. And reading financial statements, explaining this in a really simple, clear, relatable, usable way for a business owner is just one of the most valuable things that we can do for them. A lot of our clients are overwhelmed by these numbers, so explaining it is really important. So again, the operating profit margin is going to be, if you had $1,000 in sales and $300 in cost of sales, their gross profit is $700, 70%. And then they have operating expenses. They would be deducted from that. Let's say that's $400. You end up with $300 as your operating profit. That would be a 30% operating profit margin. And that's typically what we're looking at with our clients, trying to get to those goals sometimes they're called a budget. And that's what we're looking for to help our clients with.
The net profit margin is the ultimate analysis for a bookkeeper. Using this ratio, a business owner can see what their profit really is once they factor in all of their expenses and operating costs. Because the net profit margin shows the overall success of a company, a business owner can use this information to make sure that they are pricing correctly. And in general, just make sure that their business can actually be profitable in the long term. You know why they call it the bottom line? It's not a trick question. It's because your net profit is literally the last line on the income statement. Did I just blow your mind? Anyway, let's take a look at Claire's income statement to see how to figure out the net profit margin. It's pretty easy. You just take the net profit and divide it by the sales revenue. This will show you what the actual percentage of every dollar is being kept once every expense and cost is factored in. Let's see it in action. Okay, based on this ratio, it looks like Claire has a 29% profit margin. In general, this is an excellent profit margin for any business. However, remember, this can vary by industry, so it's important to make sure you do your research. Before we wrap up, let's hear from our expert.
So the net profit margin is after we have calculated our gross profit margin. Sales minus cost of goods sold is our gross profit margin. Then we have our expenses. That gets us to our operating profit margin. Then the question is, well, what's after that? Is the net profit margin. Typically, the net profit margin happens after taxes. Now, for most small businesses, and I mean the vast majority of them, they don't have taxes. Because of the type of entity structure they are, they themselves don't incur taxes. The owners do. A lot of our clients are going to be LLCs or they're going to be S corporations. So those taxes are not reflected on the business's financial statement. So the operating profit margin and the net profit margin are likely going to be the same. If your client is a C corporation and itself incurs taxes, so the business itself has its own tax return and its own tax that it incurs, that it needs to pay to the federal or state government, then they would have that tax recorded as an expense after the operating profit margin. And so then they would calculate net profit margin after that. But again, the majority of the time, it's the profit margin, and we kind of call it that instead of operating or net profit margin because there are no taxes. Now, sometimes there are people that will put income earned or miscellaneous random expenses after the operating profit, but technically from a real bookkeeping accounting perspective, it's typically after taxes. So again, net profit margin, you're going to take the operating profit margin less taxes, you get net profit margin. And again, there should be a ratio or a target that the client is looking for. And we would just help them to understand that, explain that to them, kind of put an idea together on a budget of where they should be heading to and help them to understand they've got to have the cash flow and the things that they need to be able to take care of that. And that net profit margin is ultimately what they're taking home.
Well, what do you know? I never could have guessed my income statement could tell me so much information about how my business is running. This is amazing.
Yeah, it's a pretty nifty thing, analyzing your income statement. At the very least, it gives you some more to consider before you make any decisions about your company. Anyway, it looks like you're doing pretty well for yourself.
It sure does. It might just be time to get that new truck I've been needing.
Well, let's pump the brakes there, Lou. We probably need to get a bit more information first.
Looks like we had a great year. I could buy that new truck I've been looking at.
Hold up, Lou. If you want to buy a new truck, we should take a look at your balance sheet first.
Oh, okay. I thought I was in good shape, though. I can apply for another loan. Maybe pay off the loan I have first. That'll help.
You've been doing great, keeping up with your entries and doing them correctly. This means you have information in the balance sheet that you can analyze to help you make decisions, like if your assets or equity will cover the loan you are trying to get, or if your business is doing as well as it could compared to others in the industry.
Oh, that's useful stuff, I guess, but how do I do that? Can I just print a report?
There's a little bit of calculation involved, Lou. You calculate ratios using information already on the balance sheet to look at your financial performance in different categories, like how well your business can cover its debts.
Wait, so you're gonna make me do math?
Oh, Lou, it's not a calculus exam. They are simple calculations, I promise. You use these ratios by plugging your existing financial information into the simple formulas. That Lou is always looking to buy new things. It's really typical of small business owners that have successfully expanded a little. They want to put all their earnings into new equipment and tools and services. It's admirable, but you have to be careful. We're going to show Lou how to look at his balance sheet in ways that can help him make decisions and also give him insight on how his business stands among others in the same industry. This should help him decide if he should spend more or apply for a loan or pull back a little and wait. We'll analyze the balance sheet using ratios. While there are many ratios to look at, we are going to use 4 common financial ratios that will be best for him and his business size. So, as I was saying, there are ways to read and analyze the balance sheet using financial ratios. Different ratios can tell you different things and provide answers to different questions, kind of like my psychic Paquita does for me, depending on the day. Except ratios tend to be more accurate than Paquita. Anyway, current balance sheets usually also have data from previous periods, so you can compare how financial performance has changed. So basically, these are the benefits of looking at ratios. The first ratio we're going to look at tests short-term financial risk. It's called a current ratio, and it shows a company's ability to generate enough cash to pay off all its debts once they become due. This is something a bank will look at for a loan, specifically for things like a vehicle loan. To calculate it, divide current assets by current liabilities. So, if Lou's current assets were $680 and his current liabilities were $425, his current ratio would be 1.6. That's it. But what does this number mean? If the current ratio is greater than 1, it shows that current assets are larger than current liabilities and indicates that the business should be able to convert its short-term assets, cash, inventory, and accounts receivable, into cash and pay its short-term liabilities, accounts payable. On the other hand, if the ratio is less than 1, the current assets are less than the current liabilities, and the business may be in danger of not being able to satisfy its short-term liabilities as they are due. So, Lou's ratio of 1.6 is considered fairly healthy. But the real test of the current ratio is not today's ratio, but the longer-term trend. You will want to see a consistency over 5 years or more in which the ending current ratio is above 1.0. If it's less than 1 to 1, a business doesn't have enough current assets on hand to cover its short-term debts, and it's in a tight position. The higher the ratio, the better a business can cover its liabilities. The next ratio we are looking at is the debt-to-equity ratio. This is something a creditor would look at to see if Lou's credit is trustworthy and how regular he is with his payment of loan installments. They could look at his company's debt-to-equity ratio. This ratio compares a company's total debt to total equity to see how much debt is present in comparison to the amount of equity. This is a good indicator for banks and lenders to see how much risk an owner is bearing versus external creditors. The debt-to-equity calculation is just as easy as the current ratio calculation. You take the company's total liabilities, what it owes to others, and divide it by equity. For example, if Lou's business owes $2,736 to debtors and has $2,457 in shareholder equity, the debt-to-equity ratio is 1.11. Let's look at an example using a simple balance sheet. In this example, you can calculate the debt-equity ratio by using the formula $120,000 divided by $200,000. This formula returns the debt-equity ratio of 0.6. Therefore, this company's long-term debt equals 0.6 or 60% of its owner's equity. Okay, so debt to equity is important for loans, but why else is this ratio important? A business is financed by either debt or equity, money invested by owners, or a combination of the two. Using debt financing is riskier for a company than using equity financing. As the proportion of debt financing goes up, the risk of the company also goes up. That's why calculating this ratio is important, particularly for the owner. Investors look at the debt-to-equity ratio when considering a company to invest in. A higher ratio implies the level of risk a company has, so it helps investors in deciding whether or not an investment is worth investing. Owners can also look at the ratio to demonstrate the competition in the market compared to smaller businesses. Let's hear more about the importance of the debt-to-equity ratio from an expert.
Now let's talk about our debt to equity ratio. Now, couple components of that entire statement. The debt. This is the amount of money that the business owes to a financing institution or to private individuals. So it is money that is owed out to others. Equity is the amount of money that a company has based on what their prior income, their net income or net profit or loss is, as well as any contributions or additional funds that have been put in. Of course, we always go back to our accounting formula of assets equals liabilities plus owner's equity. You could also say it's assets minus liabilities equals owner's equity. And so those are formulas that we constantly are looking at and thinking about. So as we are looking at this particular ratio, the debt to equity ratio, what we're looking at is what is the percentage of debt versus the equity in the organization. Now, what we are looking for here is how much debt do you have to run your business? When you are looking at it, sometimes people will call it a leverage ratio. Basically, if you have somebody who is buying assets or is operating their business and they're using a lot of debt to do that, then they can be highly leveraged, meaning that they're in a lot of debt. And so what does that look like? It's not always a bad thing. Many businesses operate that way, but of course there needs to be the income and the money coming in to make sure that that can be paid. Now, the way that the debt to equity ratio is calculated is obviously total liability over the shareholders or stock equity there. And that's what we're looking at. And when we look at this, we aren't able to necessarily say, this is the good number, this is a bad number, this is too high, or that is too low. It really depends on the industry and the history, the experience of the owners, and so on and so forth. It's also important that if the company is in some circles, in some situations, they will say that if you don't have enough debt, that means that the equity is being used to finance the business. And again, the converse is true where we were using too much debt to finance the business. So there's lots of different ways to fund growth and to fund operations in a business. But using this, and especially using this on a trend, what was it this year versus last year versus the prior year, month to month potentially, and so on, really gives you an idea of what that looks like, if it's going in the trend or the direction that you're wanting it to go or that the business is wanting it to go. But again, it's all about financing the activities of the business and coming up with that ratio and deciding what that ratio ought to be and moving that client, helping them understand that so that they can move in the direction that they need to be going in.
You are getting it, my little bookkeeping boss. Now that you can calculate the debt to equity ratio, what does it actually mean? Well, the answer to that is it depends. What counts as a good debt-to-equity ratio will depend on the nature of the business and its industry. Generally speaking, a debt-to-equity ratio below 1.0 would be seen as relatively safe, whereas ratios of 2.0 or higher would be considered risky. Some industries, such as banking, are known for having much higher debt-to-equity ratios than others. A ratio of 1 to 1, or close to it, is normally considered satisfactory for most companies. In general, if your debt-to-equity ratio is too high, it's a signal that your company may not be able to pay your debtors. Not a good position to be in. But if it's too low, it's a sign that your company is relying too much on equity to finance your business, which can be costly and inefficient. That being said, sometimes a high debt-to-equity ratio can sometimes be positive for a company's financial health. For example, if the earnings that the borrowed money generates are higher than the cost of borrowing it. Debt-to-equity ratios vary from industry to industry. Different norms have developed for different industries. A ratio that is great for one industry may be trouble for another industry. So you see, when it comes to this ratio, it all depends. There's only one way to do the calculation, and it's pretty straightforward. You've seen that. But there is a lot of wiggle room in terms of what you include in each of the calculation sources. For example, what some people include as liabilities will differ. Some owners will use accounts payable and accrued liabilities out of the liability number, and others might look at short-term versus long-term debt in comparison to equity. So find out exactly what your company counts in its calculation. It's common for smaller businesses to shy away from debt, so they tend to have very low debt-to-equity ratios. Usually, one of the first things the owner wants to do is to get out of debt. But that's not always the best move for the business. Owners should be using debt because it's a more efficient way to grow the business than just being debt-free. So, it's a matter of balance. Healthy companies use an appropriate mix of debt and equity to keep their businesses going strong. Just like some days I eat salads and go to Pilates, and other days I eat cupcakes and don't put on pants. Balance is what keeps me strong. The last two ratios are related. These are the accounts payable and accounts receivable turnover ratios. Let's talk about accounts payable turnover first. This ratio shows how many times a company pays off its accounts payable during a period, which shows how efficient a company is at paying its suppliers and short-term debts. The formula for this little gem is to divide the total purchases during a period by the average accounts payable. Let me illustrate with an example of something related to something near and dear to me. Bob's Bakery Supply purchased $600,000 worth of baking equipment from his vendors during the year. According to Bob's balance sheet, his beginning accounts payable was $35,000 and his ending accounts payable was $458,000. Bob's average accounts payable for the year was $246,500. You get this by adding the beginning plus the ending and dividing by 2. Based on this formula, Bob's turnover ratio is 4.1. If we divide this number by 365 days in the year, we get 89.02. This means that Bob pays his vendors back on average once every 3 months. This isn't a high turnover ratio. Maybe you think Bob should pay vendors back more quickly. But the ratio should always be compared to similar companies in Bob's industry. Generally speaking, a high AP ratio indicates that you satisfy your accounts payable obligations quickly. Next is the accounts receivable turnover ratio. This looks at a company's effectiveness in collecting the money customers owe. It measures how well a company uses and manages the credit it gives customers and how quickly that short-term debt is collected or is paid. To calculate this ratio, you add the value of accounts receivable at the beginning of the specified period to the value at the end of the period. Then divide the sum by 2. For example, Yolanda's Yogurt had the following financial result for the year. If we want to calculate the AR turnover ratio, we add the two accounts receivable amounts and divide by 2 to get the average AR amount. In this case, it's $6,000. Then, divide the net credit sales by the average AR. This gives you the AR turnover ratio. A company that is on top of collecting payments due will have a higher accounts receivable turnover ratio. Let's hear more about these two ratios from an expert.
So accounts receivable and accounts payable turnover are probably something that you can almost kind of guess at what they are to a certain extent. Accounts payable turnover is how quickly you're paying your bills. A business is paying its bills. And obviously that one, the vendors especially want to make sure that that's as low as possible. We want to make sure that the bills are getting paid on time. However, of course, a business might need to conserve its cash, and so it stretches that a little bit. So that balancing act between stretching out how long you can pay till you have to pay a vendor and them wanting it to be really short, that's kind of the balancing act that you have there, and measuring that AP turnover can be helpful. What I see more often is that a business that has credit extended to their customers where they have accounts receivable, that's the one that, of course, the business owner is going to want to make sure that they have a little bit more understanding of. And that is that they don't want it to be too low. We don't want to have our clients constantly stretching out how long they pay. And so a low turnover ratio is not going to be good for the client, the business, because they would be not getting paid. So they have recorded a sale, but they don't have the cash in the bank. And so that can be an issue. And so we need to make sure that that is something that they realize. But a high turnover ratio usually would be a good sign, meaning that they are going to have, first of all, maybe more cash sales, or they're collecting their receivables very quickly. But some people would say that it means that you're not extending credit to certain customers who that you may want to have, things like that. So there's a lot of different ways to look at this, and it really does depend so much on the business. Many professional services companies will have no real receivables. And quite honestly, a lot of times accounting systems now can integrate with payment processing so that they start looking at using credit card and debit card transactions. And even though they might have to pay a small fee, it might help with their AR turnover and help with their cash flow so much that that fee is minimal compared to what it would be if they had more of a collections issue. And so you're going to see that affecting both of these ratios. And so as the bookkeeper highlighting this, but then also highlighting a solution like a payment processor might be a way to go to really provide a value to that client as you're explaining these, letting them know about it, but then also perhaps finding solutions that can help make those issues disappear for them.
Well, Lou, what do you say? Did you learn a little bit about what you can do with your correctly entered bookkeeping information?
Yeah, I just have to look at these ratios if I want to expand my business even more, right? Simple as pie.
Why does everyone always need to bring a pie? Great, now I have pie on the brain. Thanks for nothing, Lou. Actually, there are some other analyses you should probably look at if you want to expand your business further. There are some other analyses you should probably look at if you want to expand your business further, Lou.
Sheesh, Bianca. What else can I look at?
Well, Lou, you wanted to know what to do with these numbers, and I'm telling you, there are lots of useful things available for analyzing your business. We can look at some ratios to analyze cash flows next, to see where you stand with your ability to pay off loans and whatnot.
More ratios, Bianca? It's almost too much.
What was it that Mae West said? Too much of a good thing can be wonderful? Seriously, though, it depends on what you want to know. That will determine which ratio to use. Let's check some out, okay?
Oh, all right, Miss B. You haven't steered me wrong yet.
That's the spirit. Lou is starting to see that there are many, many ways to analyze his various statements. He may be overwhelmed, and really, that's understandable. That's what you, a bookkeeping boss, are here for. And just like looking at the income statement and the balance sheet, you can analyze cash flow statements with ratios to help clients make decisions, which is what we're going to do right now. Let's first look at the cash flow coverage ratio. This measures a company's ability to pay long-term debt, otherwise known as solvency. More specifically, it is the amount of cash available to pay the borrower's interest expense. It's useful for banks and creditors to evaluate the risk of repayment, or non-repayment as the case may be. For Lou, it would be good to check this ratio if he were considering taking another loan, as it would help him understand if he were in a good position to pay off his liabilities or not. Let's see how to calculate the cash flow ratio for a business next. This ratio has some variations, but we will stick to the basics. Let's suppose Milligan's Mustache Wax wants a loan for a new manufacturing plant. You know how popular mustache wax is these days. Operations are expanding. Anyway, Milligan's bookkeeper is going to review the company's cash flow statement to see if Milligan's credit is decent and to evaluate the company's ability to repay the loan. The cash flow coverage ratio is one ratio the bookkeeper can look at. To calculate, cash flows from operations is divided by total debt. Milligan's bookkeeper reviews the statement of cash flows and finds last year's operating cash flows totaled $57,000 and total debt payable for the year was $38,000. This means Milligan's ratio is 1.5. This means the company could pay off its debts 1.5 times with operating cash flows, so that's a pretty decent ratio. Essentially, the higher the ratio is, the more cash a company has to pay off debts and have left over after paying debts. While generally a desirable ratio is more than 1, a lot of large corporations have much smaller ratios because they can fund their operations through debt. Though for a small business, a ratio less than 1 means there are fewer funds than the amount to pay off all liabilities, which for a small business means it might have to consider a refinancing or restructuring of operations to generate more cash flows. Let's hear a little more about this ratio from an expert.
The cash flow coverage ratio is really helping a company understand if it can pay its interest and principal payments when they become due for the debt that they have. So in other words, can the company pay its debt obligations? So this is obviously important, and there are many times that this is going to come into play as we're looking at ratios for the company. Just keep in mind that this is one of the ways that we measure the health of an organization. And there are times when, as a bank might be looking at something like this, there could be indicators about how solvent it is, how much it's able to have any kind of liquid assets to be able to take care of what it needs to take care of.
Another ratio you'll come across in bookkeeping is the current liability coverage ratio, aka the current cash debt ratio. Don't you love that it has a nickname? This little ditty looks at a company's ability to pay its short-term obligations. And like many of these ratios, the higher the ratio, the better. This ratio is what investors or potential investors use to judge the solvency of an entity. It tells the investors if it generates enough cash from its operations to continue business. A negative number is a possible danger sign that the company isn't generating enough cash from operations. You need to investigate why this is happening in the financial statement notes or in more subjective analysis, like looking at management and practices. You know what we're going to do now, right? Yep, we're going to calculate this with an example. Here we go. The Kitty Care had the following balances at the end of the year. The formula for this ratio is net cash from operations divided by average current liabilities. So $2,500 and $15,000 divided by 2 gives us average current liabilities of $20,000. Then you plug the numbers into the formula, like so, to get the current cash debt coverage ratio of 1.5. From this example, we can conclude that Kitty Care is liquid enough to cover its current debts conveniently with the annual cash from operating activities. It doesn't need a loan or other form of credit to clear its debts on time and is doing just fine as an entity. Last but not least, we have the cash flow margin ratio. This is one of the more important profitability ratios for business owners. It indicates how well the company converts sales to cash, which we all know is important since it's required to pay expenses. The higher the percentage, the more cash is available from sales. The cash flow margin formula takes operating activity cash flow and divides that by net sales. You know the drill by now. Let's calculate this bad boy using an example. Let's look at Splendid Soirees Event Company. I just love that word, soirees, don't you? It had an operating cash flow for the year of $34,000 and net sales of $54,000. Don't forget, net sales are found on the income statement. So, plug those numbers into the formula and you get 0.631. This means that the operating cash flow margin for Splendid Soirees is 63%. Which in turn means that for every dollar of net sales, 63 cents is operating cash. An operating cash flow margin above 50% means that the company is efficiently creating operating cash from its sales. So, a 0.631 ratio is good. The higher the percentage, the more cash is available from sales. A negative operating cash flow margin is an indication that the company is not making any profit but rather losing money. One way a company can improve operating cash flow margin is to collect all accounts receivable in a short period of time. Though this might be tricky as there's a risk of losing customers. A company can also put in incentives for customers to pay on time. Let's hear from my good friend now who will fill us in with more details about this ratio.
The cash flow margin ratio is a profitability ratio. So we are going to be looking at the ability of a company to turn its operating activities into cash. So this is going to be really helpful for a company, especially if they do have sales that are going to be on accounts receivable, so it can be used in conjunction with other ratios we talked about before. It's also helpful for profitability analysis by investors and other financial analysts. But again, it's all about taking their cash out of the revenue that they have received in that period. So really, it's cash flow from the operations divided by the net sales, and that's how you get your cash flow margin ratio.
So, Bianca, you did it again. Just when I thought I knew everything I needed to, you taught me more.
You know I'm good like that, Lou. And you know I am happy to help. And after analyzing your cash flow with these ratios, I have to say, it looks good, Lou. You have enough money coming in. It's enough to pay for your debts.
Well, Bianca, I really appreciate all your help.
Don't make me get all teary, Lou. You take care now.
You know I will.
Wow, how proud are you of our business owners from this season of Bookkeeper Rescue? And I mean, we were pretty awesome ourselves. You would think I'd take a day off after wrapping an entire season of a show. But then you would remember that I'm Bianca, the bookkeeper who never sleeps. And on today's agenda, I need to reply to some client emails. This will be great practice for you. Communicating with clients is so important. In most cases, you won't be busted into their place of business like I love to do on Bookkeeper Rescue. You'll be communicating over the phone, email, web conference, or even in person. Minus my dramatic entrance, lighting kit, and multi-camera setup. And each client will have preferred ways of communicating, including how often they want to check in or receive financial reports. Here, take a listen to one of my colleagues.
Communicating with our clients is, I think, one of the most important things that we do with our clients. helping them understand that we're there, that we care about them, we care about their business, and we communicate with them about something that is deeply personal for most of our clients. Many of our clients have started these businesses, inherited them perhaps from their families, but they're supporting their families, they're supporting their team members and their families. And so this is very personal. And for many clients, it is scary to talk about their numbers. They're embarrassed they're not making more. They don't understand why they're not making more. They want to make sure that whatever they earn, they get to keep. They want to be able to take care of their people. They are overwhelmed with some of the information, and sometimes they're just flat scared. Do I owe taxes? Do I have enough to take care of things? So we really want to help our clients understand this in a way that they can make good decisions, grow their business, keep their people employed, all of that. So the question is how do we do that with them? Well, quite honestly, it depends. How do they need to have communication with them? We have clients that want to do Zoom meetings and or some other type of telemeeting, Zoom, Teams, whatever it is, but they want to meet that way. I personally love that because I think meeting your clients face to face and seeing them, I'm a visual person. A lot of my clients are getting to see one another every month or every quarter, at least once a year. We need to be meeting with them and talking with them. I say all the time, people do business with people. They are not just looking for a machine to do it. They have hired you. They want to understand and they want to meet with you. Now, some of my clients are in other parts of the country. So of course, this is the only way we can meet, but if they're local, we do try to get together every once in a while and see them. I also want to do business with those people. So if I am able to, I want to do business with my clients, if at all possible, not always can, but I want to do that. But we do communicate regularly via email with our clients as well. I have one client that texts me all the time. I need you to take care of this. I need you to take care of that. And what I have found is that I am not always the one doing that. I have a team now. And so I want to make sure that my team knows what's going on. So I often will get a text message from a client and I will reply and say, could you please send me this via email? It takes a lot of repetition to kind of retrain them because they've been texting. So we do work with our clients on that. And we tell them, please make sure that you're emailing, please make sure that you're not texting, or if it's really important or urgent, text me and tell me to check my email. So we will train our clients the best way to communicate. I have heard of firms that have one rate that they charge a client if they're going to do emails, and it's a higher rate if they want to be able to text. And so there's options like that as well. But really the point is that we need to communicate. I know that a lot of times our clients are not even looking at the financials that we send them on a regular basis, and that's fine, but I'm still doing the work. I'm still going to be sending that to them and letting them know that those are ready. That's my product at the end of the process. And so we want to make sure that they know we're doing the work. Keep in mind, out of sight is out of mind. You need to let the client know you're there. You need to come to them with questions and with ideas and thoughts and explanations of what's going on so that they know that you're in the books. One of the other things that I will highly recommend in our world of lots of meetings and lots of emails and lots of information, short and sweet is better. Do not give the client an email that is 20 pages long with a list of questions. Bullet points often are really helpful to keep it where they can just reply. Maybe you number it so they can say 1, yes, 2, no, 3, here it is, 4, this, 5, that, instead of big long emails that are convoluted and look like they have to read a book. Most people these days, whether they have a type A personality or not, are not able to read long emails. They just have too much going on. So don't think that things are unimportant to your client. They're just busy, just like we are. So keep it short and sweet if that is at all possible. Now, the other thing I will recommend to you is to ask them how they best want to communicate. If you have a client that says email is best after X time, that's great. Let's just meet quarterly. Let's meet monthly. I really prefer a phone call. I know old-fashioned phone calls are still good. So we need to understand that. we have actually done surveys with our clients to ask them the best way to communicate with them that will meet their needs. So really, it's about a relationship that you have with your client, and it is important to invest in those relationships. So understanding how to best communicate and working through that, but not allowing them to necessarily dictate to you how you should communicate. In other words, clients don't get unfettered access to you because you are doing their bookkeeping. There are still boundaries that you can maintain. Clients need to know that you're not working at 8 o'clock on a Friday evening and all weekend long because they forgot to tell you that they needed financials by Tuesday. So there still has to be boundaries, but we also want to meet the needs of our clients. And so it is okay to decide when you're working and follow those and communicate that with the client. But it is important to invest in that relationship. I do recommend, if possible, that you do meet with your clients periodically. Again, being able to meet with them face to face as you're able to, and get together with them. Some of your key clients, of course, you probably want to do gifts and different things at certain times of the year. But I also recommend that we celebrate their wins as well. That's been one of the most fun things that we've done. We have a client that was recently sold, and we're technically going to lose them as a client, but sending a congratulations note. You've hired your first employee. That's a big milestone for a business owner that a lot of their friends and colleagues may not understand, but you do, because you've kind of gone with them through that journey. Send them something to say congratulations. Meeting with them regularly, celebrating their wins. I think all of that's really important as you develop that relationship, and your style of communication needs to match you. And so if you're a little bit more quiet, that's okay. Send them an email or a note sometimes, but doing regular communications is definitely something that I would encourage you to do.
See, just like I was saying. Well, now it's time to open up the first email and see what we're working with today. Welcome back, all my bookkeeping boot campers. Are you ready for this final week of bookkeeping boot camp? Naturally, I'm your host, Bianca, and in this final week, we will be solidifying your skills so that you'll graduate from basic to boss. You've had quite a journey here, and I've made sure not to go easy on you. We've laughed, we've cried, and more importantly, we've made it to the pinnacle week. Here, you'll be finishing up the boot camp to begin living your life as a bookkeeping boss. That's right. Well, buckle up, because it's time once again to flex those muscles and get ready to bring it home. Should we say the mantra? I mean, it is kind of a big deal, right? All right. Let's do it together. Deep breath in. Now I am the bookkeeper. I will report, not fabricate. I will state my purpose and document. I will record money in and money out. I will debit and credit. I am a bookkeeper. Uphold ethical standards. Oversee financial data. Coach clients to success. Empower prosperity. Record the entry. Add it up. Balance it out. So, without further delay, let's get going. In this round of Bookkeeping Boot Camp, we're going to reconcile ourselves with the ins and outs of reconciliation. See what I did there? I just can't help myself. All right, bosses, let's get to it. Go. You made that easier than getting to the center of a Tootsie Pop. But before you let all that sugar go to your head, we've got some work to do. Now that we've refreshed ourselves on the reconciliation process, how about we begin with a report reconciliation? Remember, this is a top-down approach that helps us see if any accounts need more attention. Often this starts with the balance sheet. Remember that balance sheet approach we talked about? That's what we're doing here. Start with the balance sheet and do a top-down comparison of the general ledger report to make sure everything is, balanced naturally. Spoiler alert! I'm going to tell you right off, this balance sheet isn't balanced. So we know right away there's a problem. Great job! You found it. I knew you could do it. To err is human, but to fix it is boss. Now that we know there's been a transposition error between the trial balance and the general ledger, we need to fix it. Fixing errors is a tricky thing and something we haven't covered in much detail. This is because fixing an error depends on the type of error made and where it was made on the books. That makes covering it a bit like trying to give advice. It's situational. In this situation, the transposition of numbers only happen when copying the credit card balance from the general ledger to the trial balance sheet. So there aren't any journal entries or suspension accounts we need to worry about. We simply correct the number in the trial balance, make a note on the account regarding the date and transposition error corrected, and voila, fixed. Don't you wish everything in life was this easy to fix? Now, let's say that instead of writing the journal entry correctly, because they hadn't hired you as their bookkeeper, that piece of equipment was captured like this. Yikes! That's gonna create some problems, won't it? So, now we have an equipment expense account that is lower than it should be, and a tax expense account that's higher than it should be. I know, tax expenses are always higher than they should be, right? Once the error is found and verified, we can correct it. Now, generally, there are two ways to fix this. One is to reverse the incorrect entry and use a second journal entry to record the transaction correctly. Or make a single journal entry that, when combined with the original but incorrect entry, fixes the error. That's the approach we're about to use. So in this case, where we've got too little in the equipment expense account and too much in the tax expense account, we can reverse this problem with a single entry that looks like this. We would add a memo on this entry to clarify that it's correcting an incorrect entry on the original date. So now we've got both accounts corrected in a single entry. Easy, right? Well, not always, but in this case, yes. Let's complete this round with some additional thoughts from a friend and colleague of mine.
Reconciliation is one of the fundamental things that we often think about with bookkeeping. It's kind of the end of the month, tie everything up in a bow and finish off the whole process. And there is just such satisfaction in getting a bank reconciliation or other reconciliations done. So we've heard about some of the very specific things that we might do to correct errors, but a couple things that I want to point out. The reconciliation process itself is really allowing us to take a step back from being in the day-to-day entry or processing of transactions and kind of look at things big picture. So when we look at reconciliations, there's a few things that we talk about to avoid making errors. So first of all, when we're going through the reconciliation, if we're seeing transactions that are the exact same amount, reasonably close on the dates, we start investigating those. Or if we get all the way through the reconciliation process and we see a lot of transactions that haven't cleared, we definitely want to dig into those a bit and determine what they are. They could have been duplicates. They could be complete errors and mistakes. It could be something like they've taken a Uber and the tip was brought in later than the actual base fare. And so those two things never cleared, but the full amount was put in the system. Things like that. There can be all kinds of random things that can be an issue. And when those get cleared up, that can significantly change what is looking, what things are looking like as far as expenses or income or whatever. Also looking at deposits that have never cleared, that's even stranger than expenses that haven't cleared sometimes. So going through all of that is really important. We have had situations where we have gone in and done reconciliations and there has been a swing of hundreds of thousands of dollars on the client's books because of transactions that have never cleared. We have found fraud as we've gone through them. That is not our main purpose, and we don't guarantee that we will, but there are times when we have seen things go through and we're like, wait a minute, this is really strange. Did you do a transfer? How come I'm not seeing it in the other account that you always transfer to? Things like that. So it's really important that we look at that. But remember that reconciling is not just about banks and credit cards. There are other accounts that can be reconciled and should be reconciled. Prepaid expenses, accruals, loan balances, all these different types of things. We have seen many times as we have done reconciliations that we have found mistakes and errors. And so going through those processes is very important. We shouldn't take it lightly. But I will also say that I don't talk to the client about the bank reconciliation and how long or how quickly it happened. They know that it's getting done most of the time. We talk about it during your reconciliation. We found XYZ that we think you should be aware of, or whatever the case is. But it's kind of one of those things that the client doesn't always want to know how the sausage is being made. It happens. We're going to do it. We correct errors. We have found, in fact, recently, one of our clients had a situation where they sent an invoice for the same exact amount to the client. They thought it was a mistake. And so they actually refunded the money to the client. And during the reconciliation process, we were like, wait, that's not what happened. This is what we found. And so we can save our clients a lot of headache and mistakes and fix things that need to happen. And so reconciliation is not nothing. It is something. It is a big something that as bookkeepers, we need to be looking at and really reviewing and keeping up with to make sure that we're providing the information our clients need to understand their processes are going well, the information is correct, and ultimately to find any mistakes that could be in the system and get those corrected.
Man, oh man, are you feeling it? That incredible feeling of becoming a true boss. Remember what we say in our bookkeeping mantra? Record the entry, add it up, balance it out? Well, now I think we're ready for the final tagline. You ready? With me. Record the entry, add it up, balance it out, reconcile. I'm Bianca, taking new bookkeepers from basic to boss. Thanks for joining me, and I'll see you in the next round. Welcome back to another episode of Bianca's Bookkeeping Bootcamp, where we take new bookkeepers from basic to boss. Now, if you have been with me this long, then you know that I love bookkeeping. And do you know why I love bookkeeping? No, it's not because I love money, although I do. No, I love bookkeeping because it's a living and breathing thing. As the financial period goes on, transactions get entered, accounts grow or shrink, and the beautiful picture of how a business is doing starts to come into view. It's really more of an ecosystem than just a list of transactions. Now, before we get started, how about we pause for a moment to begin with our bookkeeping mantra again? You ready? Deep breath. Here we go. Now I am the bookkeeper. I will report, not fabricate. I will state my purpose and document. I will record money in and money out. I will debit and credit. I am a bookkeeper. Uphold ethical standards. Oversee financial data. Coach clients to success. Empower prosperity. Record the entry. Add it up. Balance it out. Now, as you know from my previous webinars, the aim of this bootcamp is to sharpen your skills and shape you into an amazing bookkeeper. And as I'm sure you've guessed, being at the top of your field is more than just knowing how to add up numbers and record business transactions. No, what really sets basic bookkeepers apart from boss bookkeepers is the ability to recognize and understand the inner workings of a company's financials. And when you can see the inner workings, or behind the matrix, if you will, not only will you truly reach boss status, but you set yourself up as an invaluable asset for whatever company you end up working for. All right, now we've talked a lot about the accounting cycle, producing financial statements, and recently how to analyze them. However, up to now, we really just looked at the information that was listed, but never really talked about how accounts interconnect. Well, time to adjust that era. Let's take a look at some example financial statements. Hopefully they look pretty familiar to you. Okay, you ready? It's time for a speed round. Try to keep up. All right, starting with the income statement, here we have a list of all of our income and expenses, which ultimately gives us our net income. Now, that net income is important because it helps us begin our statement of cash flow. Now, on the cash flow side of things, as part of our $5,000 in sales, $2,500 of that has not yet been paid, which means we have an increase of accounts receivable. This also moves over to our balance sheet in our assets. At the same time, we had an increase in our accounts payable, which will also move to our liabilities on the balance sheet. Now, for this company, we didn't have an equipment loan, but the owner did put in $25,000 against common stock, which means that we have to factor that into the equity portion of the balance sheet. Now, stay with me here. We're almost done. At the end of our cash flow statement, we have cash at the end of the period. This is important because it goes to the top of our balance sheet to start out our assets. And finally, moving over to the balance sheet, we see our retained earnings. In a kind of circle of life situation, this is and should equal what our net income was on our income statement. Whew, that was a lot. I need a sip of water. So, here's an expert with some advice.
So let's talk about these financials and how they are connected. So here you see on the screen a profit and loss. So of course we have our income, we have our cost of goods sold and the gross profit. Then you have expenses and the net operating income and of course the net income. Now this net income of $1,900 on this particular sample company, if we then go next to a balance sheet, you're going to see that, of course, our balance sheet is going to have assets, which is what's there now. And we scroll down a little bit further, you can see liabilities and then equity. Notice that part of the equity is the net income number, that 1,900 that we just saw a moment ago. So the financial statements are connected. Your income statement flows into your balance sheet. Your balance sheet has that accounting equation that you've probably heard before. Assets equals liabilities plus owner's equity or equity. And so that's what we're seeing here. So they are definitely connected. So one of the things that we also have, of course, is our statement of cash flows. That too is connected. So if we now look at our statement of cash flows, here we are with our net income number that we just saw on the profit and loss statement, as well as our balance sheet. Now it gets a little bit different on our statement of cash flows because what you're seeing now are the differences, the change that has happened as a result of things on the balance sheet. Our income should be generating cash. Then our receivables could be generating cash because people are paying the money that they owe us. We have purchased additional inventory, and so we may have had money going out because of that. We have paid bills. So therefore, we have had money going out for that. Same thing with all these various liabilities. If there are investments, then there could be changes to our cash based on that investment. And of course, we also could have financing activities like notes payable or loans that are paid and so on. So our cash flow statement is connecting really in many cases our income, or not in many cases, in all cases, it's connecting our profit and loss and our balance sheet together. So again, our net income from our P&L plus changes that have happened on the balance sheet And of course, cash is on the balance sheet as well. We have the cash at the beginning and then the cash at the end, and we can see the net changes. So they're all connected. So you don't create a transaction that doesn't affect every financial statement. It's going to be there in some form or fashion, just either into one big entry or perhaps as others. So that's how those are all connected. So it's important as a bookkeeper to understand that they are all connected, that an entry in one place can affect something else. And we'll be talking more about that in a bit.
Ah, that's better. So, why does all this matter? Well, for one, it's part of knowing and understanding a company's financial story. I'll get to that a little later. More immediately, though, knowing how information moves gives you a better understanding of what I like to call the ripple effect of transactions. The reality for most bookkeepers is, between reconciliations and the organization of your client, business transactions don't always come to you in a nice, tidy, chronological order. What this means is that one little additional or updated journal entry can ripple through the accounting cycle and have a big impact on the financial statements. Before we move on, let's pause here and get some advice from an expert.
So bookkeepers need to understand all the various financial statements that are produced for a business owner so that they can really explain those, but also understand the effects of the day-to-day transactions on those. As an example, if a client were to purchase inventory, that is going to show up on the balance sheet. Eventually, it shows up on the profit and loss statement because when they sell something, that inventory is costed and becomes cost of goods sold, and it shows up on the profit and loss statement. So if a client has purchased a widget for $100 and then they buy them for $150, then there is going to be a change in their cost of goods sold once they get to those $150 items, depending on the costing method they're using. So it's really important to understand that. There are adjustments that happen that will affect the profit and loss statement or the balance sheet. And of course, we saw before that they're all connected. So eventually that profit and loss statement is going to affect the balance sheet because it is going to go there once the net income is recorded there. So lots of different ways that these things are connected, and understanding the effect on them is important. There are times when adjustments have to be made or corrections have to be made, and maybe one financial or another has already been produced. It might need to be run again to make sure that they're the most up-to-date information for that business owner. Are there times when we make an adjustment and it only affects the profit and loss and I don't have to rerun the balance sheet? Absolutely. But we want to make sure that we really do understand what's happening and that those are corrected and the financial statements are up to date for whoever may have run those, to make sure that they are correct and providing the information that the client needs. But the important thing is to understand what shows up where and when, understanding the flow of the transactions, being able to look at the accounting entry that has resulted as a transaction is put into the system is really important, so that we can see the flow of those and we understand that accounting entry and where things are going to show up so that we can explain those to the owner. Again, they're looking to us for guidance and information. The more we know, the more confident we are with that, the better it's going to be for that business owner.
All right, so why does all this matter? Well, going back to what I said earlier, when you know how the gears all turn, it's easier to understand the story that the financial reports are telling you. If you think back to when we first met Lou, I told you that the 4 core financial statements fit together like a puzzle. Each piece comes together to tell the whole financial story of a business. Well, when you know how all of the information flows and how the statements work together, when it comes time to review, you will gain a lot more insight into the nuts and bolts of a company. Here's a good friend of mine with a few words.
So as we've been talking about financial statements, we have encountered many different kinds and many different ways of looking at them, probably in the order of importance or in the order, at least according to business owners, that profit and loss or income statement, pretty much the same thing, are going to be the pieces that they look at on a very regular basis. What did I make? What did it cost me to make that? And what did I spend for my overhead? That's their profit and loss statement. Really important for most business owners. They almost all will say, I need to see that. Balance sheet obviously is your next one that's really important. Of course, we've talked already about how they are connected, that the net profit or loss is going to show up on the balance sheet in the equity section, but the balance sheet is showing us what we owe and what we own and what our equity is, what our interest is in the business. And so all of those things are really important. Of course, connecting the two of those together and reading information from both of those, you have your statement of cash flow telling you what happened since the beginning of the period on that report to the end. Where did your cash come from? Operations and any investments, any assets, liabilities, and those changes that have happened there. That is what you're looking at with your statement of cash flows. And those are the three main reports that we look at. Now, what we want to do when we review those is make sure that we understand the numbers that are coming through and we can account for all of them, thus the accounting that we do, the keeping of the books. We need to know that the information showing on those reports is accurate and we understand what the numbers represent. So when we look at the cash balance on the balance sheet, we know what that represents because we have reconciled that against what the bank says should be in the account, comparing it to any balances that we have on the books, along with outstanding deposits, outstanding checks, or outstanding expenses, whatever those things are. So we've reconciled those. We've reconciled what the bank says to what the books say. We can now account for the dollars that we're showing on that balance sheet. We do the same thing with all the other accounts that are on that balance sheet: accounts receivable, accounts payable, inventory, loan balances, and so on. And we reconcile those, we review those, and we make sure we know what those numbers are. We look at our profit and loss. We make sure that it's reasonable that we had a certain number in our telephone expense or subscriptions or whatever. We look at those. Is that typical for a month to month? Often, as we're reviewing financial records, I don't want to look at it in isolation of just 1 month or 1 day or 1 period. I like to do comparisons because that helps me see the reasonableness, especially with new clients. But even existing clients, you might not notice that $1,000 phone bill when last month it was only $600. We look at a lot of different clients and they may realize that's a big jump, but we may forget because we see so many things. So doing comparisons is really helpful, but honestly, it's really helpful for the client as well. They love being able to see a trend. Each month it was this and then it jumped up or went down or whatever the case is. So reviewing those financials is really important. Helping our clients to understand the importance of the balance sheet. As we get started working with a client, cleaning up that balance sheet is really important because it's going to flow into the profit and loss statement. We recently had a client that had a balance sheet that I thought looked a little strange. They had a piece of property on their books that they told me had sold and had sold for several $100,000. And yet the balance on the balance sheet was like $3,000. It's like, that doesn't make any sense that there would be an asset worth $3,000 that had just sold for several $100,000. And what we found out was that when they recorded it, they forgot to write off all of the additional expenses that they had put into that asset. And that should have been carried over as part of the cost basis for that asset. So looking at that balance sheet is really important to make sure we know what those numbers are and we review those. If you're in an accounting system, being able to run reports that help justify or reconcile those accounts is really important. Being able to understand when you look at accounts receivable and it says $10,000, we see every customer and every invoice that adds up to that $10,000 we see on the balance sheet. That is the way that we reconcile those things and make sure that makes sense. If there happened to be a really large balance for a customer that we're never going to collect, we adjust those. So as we review those things, we look at those numbers, make sure it looks reasonable, make sure we can reconcile those and tie them back to reports that give us the details of what happened. And that is going to allow us to have the confidence in the numbers that we're presenting to our clients on those financials and then help to explain that to them so that they too can feel confident about the numbers and then make good business decisions based on the information that we've provided in those financials. Ultimately, that is our goal, that we can support that business owner with the information on these financial statements that allow them to run their business and make good, sound financial decisions based on that information. And yes, of course, to do their taxes at the end of the year, they need that as well. But ultimately, our goal is to help them to run their business, and having confidence in those numbers because we know what they are, that is going to help you be set apart from many other accounting professionals and bookkeepers, because you can explain the numbers, justify the numbers, and then help the client understand those numbers.
Now, as you've heard, to go from basic to boss bookkeeper, it's important to understand how things work together. If you can do that, the financial statements will tell you more than just what the account balance is. Here, take a look at some examples of what the financial reports can tell you when you know how everything operates. So, there you have it, the workflow of the financial statements. It's pretty amazing to think about how all of these things really work together and impact each other. It's really hard to think about what people did before they invented double entry accounting, you know? Anyway, I could spend hours talking about this topic, but I know I'm short on time. Make sure to join me next time for my final bookkeeping bootcamp episode. I'm Bianca, taking you from basic to boss. Thanks for joining me. Friends, you've reached the final episode of Bianca's Bookkeeping Bootcamp. You've come a long way, and I'm very proud of you, my little birdies. I've enjoyed watching you learn and grow. You've worked hard and stuck it out. You are strong. You are competent. You are bosses. You are my little bosses. And I'm going to miss you. But hold up. There's no crying in bookkeeping. So, before Bianca gets all sentimental and ruins her mascara, we have a final topic to cover. Let's get to it. In this session, we are going to dig in and see which reports or ratios we can analyze to answer particular questions about a business. This will give you practice on determining where to look for information to answer a particular question you or a client may have about a business. You'll also get some new information on additional reports and what information they can provide for clients. You already know that when you want to know information about a company, the financial statements hold all the information. So, why are we looking at reports instead of directly at financial data, you ask? Well, reports provide more granular data than financial statements produced monthly or quarterly. Whew, that was a lot of information. But reports are the extra secret sauce that will help your clients understand their finances and make decisions. For example, if a company wanted to see what their best-selling products are, you could run some sales reports, specifically a sale by product summary report. This report displays all products sold over a selected period of time. It also lists the total monetary amount sold, the total percent of sales that the product represents, the average price it sold for, and the cost of goods sold, gross margin, and gross margin percent. All that from one report. If the same company wanted to know their inventory status, you could run an inventory report, and to be precise, an inventory valuation detail report, which shows you the transaction for each inventory item and how they affect quantity on hand, value, and cost. Pretty nifty, huh? Let's hear more about reports from one of my favorite bookkeeping camp graduates.
Reporting. This is one of those areas that we absolutely love and customize per client. Not necessarily that we customize the reports, although that's often helpful, but it's also customizing the types of reports we send to our clients. Keep in mind that clients do need to know about financial information, But a lot of time, we want to be able to provide operational reporting. If your client is using jobs, they need to know profit by job. Which job is most profitable? Which one is not? Where are we at in the process? Have we met the margin of profitability for that particular job that we were looking for versus some other type of job, or as a whole, what is our profit margin and what percentage are we at? Sometimes clients will take a job that's less profitable because it's going to lead to more work. And so therefore they know those changes are going to happen in their overall profitability, but yet we'll do that. So having that understanding and working with the client on that is really helpful. Payroll, of course, is one of the biggest expenses for most small businesses. A lot of reporting related to payroll, and not the gory details that you and I might like, which is, payroll taxes and all of that, but just general overall information, and potentially even looking at payroll by department or by types of employees, different ways to look at that information rather than here's your payroll report. That's just, the net payment to employees and whatnot. So there's a lot of different ways to run it. We also may need to be looking at sales information. Depending on the type of business they are in, there could be categories of sales or customers, categories of customers that we need to look at for sales, or wholesale versus retail customers, things like that. Profitability by product line also can be really helpful. If the client's carrying inventory, there is a ton of reporting related to inventory. How fast is it turning over? What is our margin on that inventory? How much do we have in inventory? How fast are we turning it? We've worked with one client, when we ran the inventory report, it didn't seem unreasonable that they had $200,000 in inventory until we realized that that was all the inventory they needed for the next 3 to 4 years. And so they had a lot of cash tied up in their inventory because they had laid out $200,000 in expenses for what they would need for the next several years. So it wasn't a surprise that they had cash flow issues because it was sitting literally in their inventory in the warehouse. So understanding that and helping them realize what's going on in their business is extremely important. Finding out that they could have a sale on that inventory and generate some cash, even though it's not as much as they want, it allowed them to convert that asset into something that they really could use. So running those reports, understanding payables and understanding that they need to have cash in the bank to pay those bills is important. So helping them understand that and running reports related to that. Understanding accounts receivable reports and running those so that they can see we have really old receivables. If we're not careful, it's possible those over 90-day receivables, depending on the client and the business that they are in, could become uncollectible. And then that's a problem. So really getting into those reports and finding out what reports make the most sense for the business that allows them to make business decisions is just critical for the role that we play. And again, remembering that a lot of our clients are very overwhelmed and not understanding the financials. Getting into that operational reporting will help them gain confidence in the information you're providing them, help them clean up things that perhaps they haven't seen before. And then as you relate that to what they're seeing on the profit and loss statements or their balance sheet, also helps them kind of pull it together. When they see a big number on their profit and loss statement and they don't understand the details behind it, and then you can show them those details on a sales report, man, that is just that golden moment when the client is like, aha, I get it. And that is really a lot of fun. So run those reports, help the client understand what it's about, show them where that is on the financials and help them relate it to that. Also keep in mind, depending on the system that they're in, I mentioned customizing the reports. Again, a custom list of reports to give the client, but then the reports themselves might need to be modified to really provide the information the client needs. Some reports, depending on the accounting system you use, will have more information than the client needs, and it just gets overwhelming. And sometimes it's missing a key piece of information. So really understanding what they do, I had a client one time where I handed them a profit and loss statement, and I could see them just rolling their eyes. They're like, oh, gracious, what am I going to look at here? And I would ask them, I said, do you see this every month? Yes, I see it every month. What is the number that you look at? And I literally gave them a pen and said, circle it. And they showed me 2 or 3 numbers, and I was like, awesome. Then taking that information, going back and running the details so they could see what that was, really opened their eyes. And then we went through and started talking about making that profit and loss statement more meaningful to them. That was an incredible moment for them, where they really started understanding what they were looking at. And so you'll get to that point with your clients as they gain confidence in what you're doing, and as you understand their business better, just making sure that you're pulling reports and giving them reports that make sense to them and that you can help them understand, is really what you want to be doing for your clients.
Reports are great, aren't they? They can tell us a lot. But sometimes you need to know something more specific that a report doesn't tell you. For example, if a company wanted to see how fast inventory was selling and how its sales stacks up to other products in its class category, you can look at the inventory turnover ratio. This ratio measures the number of times inventory has been turned over or sold and replaced during the year. It is calculated by dividing total purchases by average inventory in a given period. A high inventory turnover generally means that things sell faster, and a low turnover rate indicates weak sales and excess inventories, which could be a signal to sell off some of those goods at lower prices. This ratio, and any other for that matter, can be compared to industry averages to gauge competitiveness and performance within the same industry. Let's take a look at some helpful ratios you may not be familiar with yet, but will be good to know and use in your new bookkeeping life. How about let's apply some ratios to a public company? I know you are as excited as I am. We'll start with the current ratio. This measures short-term financial risk by showing a company's ability to generate enough cash to pay off all its debts once they become due. We'll apply this to Walmart. Looking at the balance sheet, if their current assets for 2020 was $61,806 million and their current liabilities was $77,790 million, the current ratio would be 0.794, or rounding up to 0.75. This means that for each dollar of current liabilities, Walmart has only 75 cents worth of current assets. That being said, due to the tight working capital requirements, companies in the retail sector generally have a very low current ratio, in the range of 0.5 to 1 times. So, for the industry, this isn't a bad number. Let's look at another public company, this time Amazon. From this balance sheet, we can see that current assets are $132,733,000 and current liabilities are $126,385,000. This gives us a ratio of 1.05. If we were to compare these ratios, we could conclude that Amazon has better liquidity management than Walmart, and that Walmart has a bigger stock of inventories than Amazon, and it would have to sell off inventory in order for it to fully pay its debts. Comparative industry information is out there for everyone to see. Use it when you run any ratio. Let's look at another ratio example. This one is a little more complex. Joseph's Voice Lessons has the following income statement for this year. You want to find out if Joseph is generating enough profit from his sales and lessons and whether operating costs and overhead costs are being contained. To do this, you will look at his net profit margin ratio. This ratio tells you how much net income he generates as a percentage of revenue. The formula is after-tax net profit divided by net sales. But to get these numbers, you need to do a little calculating. We take the total revenue of $6,400 and deduct variable costs of $1,700 as well as fixed costs of $350 to arrive at a net income of $4,350 for this period. If Joseph also had to pay interest and taxes, that too would have been deducted from revenues. The net profit margin is calculated by taking the ratio of net income to revenue. Net profit margin is calculated like this. A net profit margin of 68% means that for every dollar generated by Joseph's voice lessons in sales, the company kept 68 cents as profit. The net margin is an important measure of a company's overall profitability. Larger profit margins mean that more of every dollar in sales is kept as profit. Let's hear about the importance of ratios from an expert I know and respect.
So you've seen the conversation and probably read and heard about various ratios. There's current ratios, there are net profit margin ratios, and so on. And many of these are very important depending on the client that you're working with. There is no blanket, you should always run this one and you should always find this number and it should always be this rate or this range of ratios, because every industry is different. There are businesses that run with a very slim margin. And so if they had a 10% gross profit margin, they would think that is phenomenal. But then when they get to their net profit margin, they might be looking for 1% as their profit, and that might be really good. There are some that are running with no cost of sales. So their gross profit margin is 100% because there's no cost of sales. It's all revenue. Then they have their expenses and they might be looking for a 70% profit margin ratio. So there are different industries with different ratios, and it is going to be to you important to know what those are for the particular client in the industry. Keep in mind that many clients, again, are a bit overwhelmed by some of their numbers. Not that they're not intelligent, it's just something that can be a little intimidating for some clients. And so we can put those on our reports to help them get used to seeing it there, help them understand, help them realize that this is about creating a target of where they want to be going. And so that's the kind of thing that we look for. Now, you can look again at different industries, whether it's a roofing company, a construction company, a professional services company, a retailer. Each of them will have different ones. So having a general idea for a client that might be interested in ratios or that you think could benefit from understanding those, do some research on those for the ones that make the most sense for them. Compare it historically. If you have their information from a year ago, run those ratios and look at them. Compare that to where they are today. Has it gotten better or gotten worse? And what were the drivers of that? What happened there? Did they have a big change in their business? Did they hire more people? Did they have a big job that they did? Did they land a big contract? Did they lose a big contract? What were some of the things that may have changed? And as you are analyzing that information from a prior year to now or months ago to now, it might be even helpful to show that to the client. Help them see that information. Again, showing something at one point in time for a client often isn't going to tell the whole story that they need to know. Looking at those ratios year over year, period over period, can help them understand what's going on in their business, and they know their business better than anybody. So looking at that and then asking some questions about what may have changed in their business during that time period could help them also understand how that affects their ratios that they're looking for. And then being able to get into some specifics there. You may also find that there are certain ratios that make sense to you that you're able to then take and explain in a way that makes sense. Again, inventory turnover. Most clients that have inventory know what that means. We have purchased inventory. How fast does it take us to sell that and turn over that inventory and buy new inventory and so on? They're familiar with that. But even for those clients, not all of them have quick turnovers. Many of them are holding on to things for a long time. And so turnover is a different ratio, even depending on the type of inventory that they carry. So learning about that, applying the right ratios to each client, helping them to be able to take action on that or understand it for any outside third party that needs to know those numbers. That's what we're trying to do. And ultimately, as the bookkeeper, if we're keeping their books in good order. We're reconciling the accounts. We're making sure that the numbers represent what they're supposed to represent, and they are tying to more detailed reports, and the information is accurate. Ultimately, those ratios are up to the business owner to affect. We're just making sure that they have good information so that they can run the reports, see the ratios, and then take action in their business based on the information you've presented to them.
My little bookkeeping bosses, you've made it to the end. You've learned so much. You've gone from zero to hero, from basic to boss. And now it's time for you to leave the nest. It's been a long journey, but you are finally ready to fly on your own. My work here is done. Never forget the bookkeeping mantra. Record the entry, add it up, balance it out, reconcile. I'm Bianca, signing off. Thanks so much for joining me on this journey. Good luck and happy bookkeeping.
The Intuit Academy has created new training for those who are interested in learning all about taxes. Intuit Academy's mission is to offer cutting-edge online training programs that 1. Unlock high-demand job opportunities. 2. Ensure Intuit's customers receive a world-class service from highly skilled experts. And 3. Foster a culture of learning and growth, attracting and retaining high-caliber talent to the Intuit Expert Network. The Intuit Academy is committed to helping learners develop the skills they need to be prepared for jobs in the innovation economy. Whether they own a business or want to switch careers, the Intuit Academy Tax Level 1 training is here for those with the courage to grow. This training is a transformative learning experience designed to prepare all types of learners to take a tax exam. The courses introduce learners to foundational tax topic information using real-world scenario examples. The Intuit Academy Tax Level 1 training is a way for individuals to gain knowledge of tax principles, the tools needed to identify problems, brainstorm solutions, and much more. The training promotes creativity, critical thinking, complex problem solving, and other skills that are valued in today's workforce. This training is key in promoting skills to prepare learners for the workforce and to position themselves as credible job candidates. Those that successfully complete Tax Level 1 will be invited to explore career opportunities with Intuit's TurboTax Live. Individuals who complete the Intuit Academy Tax Level 1 training will be encouraged to add their badge to their LinkedIn profiles, resumes, and other career builder tools. Individuals will also be invited to take future courses created by the Intuit Academy.